all over the country. Yeah, good afternoon, sir. I welcome Professor Mahesh Agnihotri Garu to this first session of the day. Sir is going to speak on fundamentals of investing. Now we know very well everybody wants to invest in one or another way. There are different securities are there, or there are some other alternatives like gold, silver, or maybe buying land, house like. But whatever we are going to take a decision of investing, what are the fundamental aspects that we have to consider? So the fundamental aspects of investing is going to be addressed by Professor Mahesh Agnihotri Garu in this particular first session. Yeah, I want to speak about Professor by taking 1 or 2 minutes. So he is an extraordinary speaker. Now Agnihotri is a retired faculty of commerce from Hyderabad. After taking VRS, he worked in Oman and the UAE Dubai for 16 years. He has presented and published a number of research papers in Asia, Europe, and North America, which includes an international business conference in the oldest academic society called Society for the Advancement of Management, established in 1910. His latest research paper published recently is Impact of COVID-19 Balancing Demand and Supply Forces. He is actively involved in publishing episodes on podcasts on the topic Fundamentals of Investing. His episodes are available on Apple, Google, Spotify, and many other sites. It is being heard in about 18 countries. Sir, we are very much grateful to you, sir, for your presence. And in this particular session, I welcome you. And you have to continue up to 3:30, sir. The session is
Okay.
welcoming and open to you, sir. Thank you.
Thank you, Dr. Naresh Reddy Garu, for speaking some good words about me. But what all I can say is I am a learner and I would feel happy to be amongst the students. And I would like to share my knowledge whenever anybody seeks anytime. And it is always a pleasure for me. I thank the various professors of Osmania University, Professor Krishna Kumar, Head of the Department of Commerce, Professor Gopal Reddy Garu, Registrar, Professor T. Krishna Rao, Officer on Special Duty to the Vice Chancellor, Professor D. Apparao, Dean Faculty of Commerce, Professor D. Chennappa Garu, Coordinator, RUSA, and Principal of the University College, Professor Prashant Atma, Chairperson BOS Commerce, and Professor Sriram Venkatesh Garu, Nodal Officer RUSA, and all other students who are here today. I thank everyone for being with us today. And I congratulate Dr. Naresh Reddy, the coordinator and director of the workshop, and the entire department for organizing such a successful online workshop on financial literacy for postgraduate students across the length and breadth of the country. It is not an easy job. And I am sure this workshop will help the students in so many ways. Congratulations to you. And I also congratulate the Center for Promotion of Financial Literacy for choosing a very important topic, that is the financial literacy. And that is, I think, the need of the hour, not only in India, even in other countries. This is the need. And this is particularly important after the pandemic. How many businesses have lost their money? And now this is a lesson. There was a setback, and now we have to come back after the setback. So I would like students to remember there was a setback, but you have to come back. That is the only solution. We have to be successful. I'm glad to speak on the topic fundamentals of investing today. to the young citizens of India, and they are from various universities and colleges from India. Thank you, young ladies and gentlemen, for being here today on the workshop with us. I'm sure some of you are active investors, and some of you are planning, and some of you don't know whether to start or not. So there are different types of students. So I will be addressing to all of them one after the other. But before we discuss the topic, let me tell you that I have been publishing episodes on podcast under the title Fundamentals of Investment. So far, I have published about 10 episodes, 10. And these episodes are available on Anchor Podcast, Spotify, Google, Apple, and many other. Those students who would love to know more about investing, you can see these on the Apple or Google podcast or any other. Actually, these podcasts are being heard in about 18 countries. So listeners may use this for enhancing your knowledge. And there is always not enough to know more about investing. Even now, today, I feel that I should learn more about investing. Today, after a brief introduction of the term investing, and also a brief introduction of the term stock market, we will discuss why stock prices sometimes go up and sometimes go down. You have been watching on the television, there are some stocks which are shown in the green, some stocks are shown in the red. So why do stocks go up or go down? We will discuss that. And then we will also discuss, if time permits, we will also discuss the various factors to be considered by new investors who have some money to invest, but they have not started yet. They will be starting to invest. They are still thinking when to start about that. So we will discuss that particular topic as well. This topic, fundamentals of investing, is good for those particularly who have financial independence. They have some money, they can play with it, they can use it for good purposes. And also to those who will be having soon some financial independence, because I'm sure most of you will start working sooner than later. I wish you all the best that you get a good job and start investing. Okay, so, and I'm sure some of you may be reading newspapers, maybe reading Economic Times, and you are in touch with the stock market, but not all of you. So those of you who would like to learn more about the functioning of the stock market, how stocks react, let us discuss today. I'm sure most of you might have heard Mr. Warren Buffett, one of the greatest investors of all times. He is one of the richest Americans today. He started investing in stock market at the age of 11. When he was just 11 years, he started investing. And he bought 6 shares, 3 for himself and 3 for his sister. And then he bought it for some $38. And then immediately what happened was the price went down from 38 to 27. But finally, in a couple of weeks, he could sell the stock for 40 and made some profit. Then he got an idea that, yes, I can make some money here. Then at the age of 13, he declares that he shares with his family friends that by the time I turn 30, my age is 30, I will be a millionaire. This is what he challenged his friends. He said that if I don't become a millionaire by 30, then I will blah, 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 blah. I don't want to share that. That is not that is challenging. So I don't want to say that. But that is what Warren Buffett said when he was 13 years. So he feels that he was late in starting to invest. Now, we all have a question. Did we start, or what time did we start? Or even now, better late than never. Because Warren Buffett says, if you are not investing, you are doing it wrong. If you are not investing, you are doing it wrong. That means he says, start investing. But how? Some people say, I don't have money. He says, save money and invest. But never take loans. He is against the principle or the practice of taking loans. So he says that save and invest. And I add my statement to what Warren Buffett says. Invest today for a better tomorrow. I repeat, invest today for a better tomorrow. I think you all agree to the fact that all of us would like to have a better tomorrow. All of us would like to have a happy and higher standard of living. So, in addition to your jobs, you can still invest in stock markets. And in fact, everyone wants to make money. Everyone, more and more money. But it sounds so great, so simple, but it is not so easy, because there are instances people have burned their money, their hard-earned money, because investment is putting money to work for some future gain, but investment involves risk. There is no investment which is 100% risk-free. When it comes to investing, yes, there is some element of risk. And in fact, all financial assets, cash, fixed deposits, investing in stocks, investing even in bullion market is risky. When it comes to investment, there are three types of investors. One is risk-averse investors. Who are these risk-averse investors? A risk-averse investor is one who prefers lower returns, say 5%, 6%, 7%. He prefers a lower return with known risk. He wants to know that this is the risk and this is my minimum return, or 6 to 7%. He prefers lower return but with known risk. Then we have another category of investor. He is a risk neutral investor. This gentleman, he wants only gains. He doesn't bother much about the risk. He is just interested in focusing on gains only. Then we have the third category of investors, that is risk-loving investor. This risk-loving investor is one who believes in taking risk and he believes in taking risk and for achieving higher rate of return. Higher the risk, higher the return. He knows that is why he takes risk to earn a higher return on his investment. So now we have understood that there are three types of investors. One is risk-averse investors, and most of the people are risk-averse. They don't want to take risk. I think most of you who are attending this workshop today, if you start investing, you also are risk-averse, and you should be risk-averse in the beginning. Later on, with more experience, with more knowledge, yes, you can become a risk taker, risk-loving person. You can become later, but till that time, no, you should be a risk-averse investor. Those who are risk-averse investors, for them, I suggest they should invest in term deposits or fixed deposits of banks or post office savings, because if you invest there, it is a risk-free asset. Let me tell you what is a risk-free asset. A risk-free asset is one asset which will give you definite returns, but there is no such loss in future. It is not 100% guarantee, but 99.99%, there is no loss of your capital when you invest in risk-free assets. So term deposits or fixed deposits are risk-free assets. Other investors, those who want to take some risk, they can go for investing in mutual funds. Mutual funds, they take your money and they add their money and invest in some other corporate stocks. But then investing in mutual funds, investing in bonds is a bit riskier than investing in term deposits or fixed deposits. So depends on the investor to take some risk, but when you take some risk, there may be a little higher rate of return as well. Then those investors who love taking risk, they can invest in stocks. As I told you, investing in stocks is very risky because you never know a stock which is doing well, suddenly it may fall due to so many reasons, because stocks react to the market information. So anything happens, the stocks react and the prices go up or go down. And we will be discussing this later today. Why do stock prices go up and go down? So there are other options that people can invest in. People can invest in bullion, that is, people can invest in gold and silver. And the best option to invest in gold is, I suggest, purchase an ETF, exchange traded funds. But I don't suggest you to buy gold in jewelry. If you buy jewelry, when you want to sell, you lose 20 to 30%. So don't buy gold, buy gold in exchange traded fund. It is not a physical gold. So it is on paper, and when the price goes up, you gain. And when there is a fighting trade war going on between the US and the other country, China, that is, forcing the gold price to go up. Now, this is the right time. I feel that one should buy gold. That is what I guess. But still, it is up to you to take that risk, to take that call. Okay, so There are people who invest in real estate also. But these days, after the pandemic, everything has been, taken to task. So people can invest in any of these class assets. Options are available to them depending on what they want. So if you have decided to invest in stocks, you should be investing in stock market. Let me tell you, for the benefit of those who would like to know, what is a stock market? A stock market is an equity market, or it is a public entity of the public entity for trading of shares, which were earlier allotted to the shareholders by means of an IPO. IPO is initial public offering. So once people are allotted shares in an initial public offering, now it is issued to them. Later on, these people, those who have shares already, can trade their shares, buy and sell shares in a stock market. And stock market is a secondary market where shares are bought and sold. So what happens in a stock market? In a stock market, an auction takes place between two parties or two persons. In a stock market, an auction takes place between two parties, and they are called as bulls and bears. Bears believe that the existing stock price is high and will drop, whereas bulls think that right now the prices are okay, but very soon the prices will go up, and he wants to make profit out of that increase in share price later. So in stock markets, an auction takes place between two parties, bulls and bears. So that is how the trade takes place. Let me tell you another classification of investors. Number one is intuitive investors. Who are these intuitive investors? These intuitive investors are those who just invest on the basis of their wild guess, their own instincts, their own hunches. They don't do any calculations. They don't do any research. On the basis of their instinct, they invest money in stocks. Now it is up to you to guess whether that practice of investing in stocks on the basis of instincts is correct. The answer is a big no. So don't be an intuitive investor. Then the second category of investors is a passive investor. Who are passive investors? These passive investors are those who believe in technical analysis. What is this technical analysis? Technical analysis is the historical data that will be given to you on the system or online, and basing on this historic data, investors, experienced investors, guess the trend of the stocks, how it will go on the basis of the past, how it has behaved in the past. Now, what is the likely trend? They would like to see that. So passive investors use technical analysis. We have seen intuitive investors, then we have seen now passive investors. who believe in technical analysis or who use technical analysis to trade. Then we have another category, that is the active investors. These active investors believe in fundamental analysis. What is fundamental analysis? Fundamental analysis is the analysis of the financial statements of the company. How much profit it has made compared to last year. Has the profits gone up or have the profits gone down? What about the sales? The revenue has increased or not? The bottom line is every investor would like to see the revenue and some ratios. I think some of you are aware that you have calculated ratios when you are studying BCom. Earnings per share ratio, current assets ratio, liquid assets ratio. All these ratios help fundamental investors, that is active investors, to analyze the stocks. But the time is a very important factor in investing. So that also should be kept in mind. So we have seen another classification, that is the three types of investors again here. Number one, intuitive investors. Number two, passive investors. Number three, active investors. And we have seen the approaches of all the three types of investors. Needless to say, I don't have to say, investors have to analyze the stock before they buy. It's easy to buy. If you have money, you can buy a stock, because any time you can buy, because stocks go up. And the problem is, after buying, when to sell is a very, very difficult choice to make. Let me tell you my story. When I was a young teacher, some 30 years, 35 years before, I had just joined as a faculty in commerce. My students would trade. So even I thought I should also trade. So I got an allotment of a share. And immediately after the shares were allotted to me on an initial public offering, when the first time, when the share was traded in the stock market, there was a jump of, say, 20%. I was happy. And then slowly the share price went up. Then I thought I will sell it at the rate of, after the share price doubles. I did not sell. I did not sell for a long time, and I was busy. I could not focus on investment. Then what happened now is those shares are not being traded in the market. They are not seen. So there is a greed. One should avoid that. So you have to focus on your investments. It is not just buying and forgetting. Yes, if you are a long-term investor, yes, you have to invest for long-term, but you have to watch. So I did not watch, I lost. And that was a very good learning exercise for me. Okay, right. So we have seen what is technical analysis. And let me tell you again, technical analysis is the study of historical market data, And this market data shows the price and the volume. Actually, there are two forms of technical analysis. One is chart pattern, and the other one is technical indicators. These two things help an investor in making choice as to whether they should buy a stock, if they buy, at what price, and if they want to sell, and at what price. Okay, so again, to repeat again, what is a fundamental analysis? The fundamental analysis of a business involves analyzing the financial statements of a company, what competitive advantage it has, what is the role of management, how effective is the management, and who are the competitors. All these things have to be considered in the fundamental analysis. Fundamental investors use economic analysis also, and they try to calculate the intrinsic value. Students of commerce may be knowing what is an intrinsic value. Intrinsic value is the real value, and if the real value of your stock is more than the market price, you should buy it. Suppose the intrinsic value of your stock is 100 rupees and it is trading in the market for 80 rupees. So you should buy the stock because you are paying less. So intrinsic value is also called as the real value. Then if the intrinsic value of the stock is more than the market price, investors can buy the stock. So now the question again comes to your mind is stock prices go up and go down. And this happens every second. Just as a soldier has to be ever vigilant on the border, even a slight delay of even for a second, when the soldier fires his bullet, 1 second later after the crossing over of the enemy, then the enemy will fire and he will be in a big problem. So time is a very important factor in stock market. So prices change every day, every hour, and even every second. Why? Why do prices change every day, every hour? It is not that every stock will change. Some stocks may not be traded on a particular day, and some stocks may be traded so many times in a day. That depends on the information that the stocks react to. Stock prices change because of the result of the market forces, demand and supply. In fact, I had written an article on the importance of demand and supply. Everywhere it is demand and supply which plays an important part. The salary you get after you choose a job, it is definitely because of the demand and supply in the market as far as the private jobs are concerned. Anywhere for that matter, you buy apples, it is the demand and supply. So in the same way, stock prices also are the result of market forces, demand and supply, which make the market either bearish or it makes it bullish. And a bullish economy is very good, whereas a bearish economy shows that there's a decline in the performance of the business of the companies. Then, if the company's performance is good compared to the last year, the share price of the company goes up. And investors who generally follow fundamental analysis, they compare the last year's sales with the current year's sales. And not only that, if they see that even the projected sales are good, the company's share price goes up. So the most important factor that affects the value of the company is the earnings. The most important factor which affects the value of the company is its earnings. And all of you have been hearing the reports that earnings have gone down in most of the companies, whether it is airlines or restaurants or any company for that matter, except a few like Amazon and some automobile companies like Tesla in United States. Most of the companies have reported a decline in their revenues. So what is value then? Uh, the values of the company is not just the share price. Value is the market capitalization of the company. If the market capitalization is good, that means the value of the company is good. Let me tell you the meaning of market capitalization. Market capitalization is the value of a company that is traded on the stock market. Then how do we calculate the market capitalization? The market capitalization is calculated by multiplying the total number of outstanding shares by the share price, by the existing share price. That will give you the market capitalization of that particular share. There are different levels of market capitalization. You should understand when you start investing, you should know that what are the various levels of market capitalization. Number one is a mega level. There are very, very few companies in this level. Firms with a market capitalization of over $200 billion come under this category of mega market capitalization. Then we have large cap firms. These large cap firms have a market capitalization of over $10 billion. This is categorized as large cap firms. Then we have mid cap firms. Mid cap firms are those firms whose capitalization is between $2 billion and $10 billion. It is between $2 and $10 billion. That is called as mid cap firms. And those firms with less than $2 billion come under small cap firms. So there are four categories of market capitalization. Then mega capitalized firms, large cap firms, mid cap firms, and also small cap firms. I repeat again, mega capitalized firms, then large cap firms, mid cap firms, and also the small cap firms. But now you may have a question, where should I invest? Whether should I invest in large cap firms or mid cap firms or small cap firms? It is good to invest in multi-cap firm, not large cap or not mid cap or not small cap. It is better you invest in multi-cap funds, which is a mix of all that. So there it is a better option to invest in multi-cap firms. Whatever maybe whether that is multi-cap or large cap, but one thing is for sure, it takes years. It takes years for us to become the master of the techniques which are to be understood in the stock market. Let me tell you, investing in stock market cannot be a hobby. I will work every day and then 5-10 minutes I will buy a stock or sell a stock. No way. You are not doing justice to your investment. It is not a hobby. It cannot be a hobby. It cannot be a time pass activity. It has to be a focused activity. You have to do a bit of research now and then. And it is not that you're holding 100 stocks. Hold a few stocks, hold or buy and hold a few stocks, and think of long-term investing. If you are an employee, it is not possible for you to trade every day as an intraday trader. So what you have to do is buy value stocks and have patience. Invest as if the stock market is going to close for 5 years. Today I buy some stocks, and from tomorrow, stock markets are closed for 5 years. So with that intention, with that attitude, buy a stock. I'm sure you will not lose. But again, the stock selection should be very, very careful. Companies like Mackie, companies like ITC have been in the business for a long time. Nothing happens to these. They sometimes come down only to go up later. I think you all might have heard about the company ITC. They sell atta, they sell tobacco, and they are into hotel business. They are very, very reliable companies. So I'm not saying that you should only buy ITC or Mackie. Yes, like that. Value companies which have been in the business for long, then we'll see in greater detail later. But to tell you in short, you should not follow it as a hobby, and it is not a time pass activity. Remember, because your money is a hard-earned money. You can make use of this money so well, and you can invest it. You can make use of this money for your family. Give them some good things in their life. And that is why invest it with wisdom, invest with some knowledge, invest it with some experience. Don't be an intuitive investor. You can be an active investor, you can be a passive investor, but never ever be an intuitive investor. Okay, right. So now we come to the point. Why do stock prices go up or go down? I'm sure the moment you see, you turn off the TV, some of you, and some of you are glued to that Z Business News. But even if you are not an investor, read Economic Times daily for about 15 to 20 minutes, half an hour. You may not understand in the beginning. Some of you may not. Even I did not understand in the beginning, but a continued, subscription and continued reading will help us to understand things better at a later stage. So please read Economic Times or any business news which is having value. It is not a newspaper report. Okay. All right. Now let us see, why do stock prices go up or go down? So this is very clear to most of you, but for the benefit of those who do not know, let me tell you that what does the green and the red symbols mean in the stock market. Green symbols indicate that the price has gone up, and the red signals indicate that the price has gone down, which we don't like. When we have bought a share, when you are about to sell, and if the price goes down, we dislike it. Okay, so let us see uh, the why do stock prices go up or go down. Before that, I feel that I should make things clear to you as to what is a stock market index. Because people say stock market index is going up, going down, but you should know what is a stock market index. Only then you can proceed to invest in the stock market. A stock market index is an index that helps investors, all types of investors, not just X, Y, Z, everybody. A stock market index is an index that helps investors compare the current prices of the stocks with the past prices. And this is to calculate the market performance. We can calculate, we can know how the market has gone over the day. How many reds, how many greens overall, how many points in minus, or how many points in plus. So at the end of the day, when you see that at the closing bell, it is reported that stock market ended today with 230 points plus, that everybody welcomes it, because everybody wants to make money. Okay, all right. So stocks go up because more people want to buy rather than sell. As I told you earlier, is the demand and supply. Stocks go up because more people want to buy rather than sell. When this happens, people start bidding higher prices than what is currently being traded. If a stock is sold at 10, people bid 11, more and more and more people demand, and then when the demand goes up, the price also goes up. And on the other side, the flip side, the stocks go down because more people would like to sell their stocks. More people are willing to sell. The demand goes down. Maybe they have come to know something bad about the company, or some people want to sell because they want to have money for their personal things. Anyway, the demand goes down. So when this happens, the price go down. But if you have invested, or for all the people, this is a frustrating experience, and people would not like to see the stock prices going down. So when stock prices go up or go down, you can say, if it is happening more frequently, you can say that stock market is volatile. And this volatility of stock markets, if that is there, a new investor may lose. But when there is a volatility of stock market, only experienced traders profit from such situations. So, but volatility is there. Sometimes it is too much, and sometimes it is not much, but there is volatility. And experienced traders profit from such situations. But others also, some others may lose also. It is not that everybody profits. So, but before I tell you why do stock prices go up or go down, let me give you some more knowledge to understand what is risk. Risk is what? It is an uncertainty, right? Uncertainty of a happening. When you're a small child, when you started walking, there was a risk of you falling down. Your parents trying to hold you. You did not fall down, but there was a risk. So uncertainty was there. So there is the same thing. Risk is there in the stock market also. Agreed? Okay. There are two types of risk: systematic risk and unsystematic risk. Let us understand what is systematic risk first. Systematic risk is also called as non-diversifiable risk, a risk which cannot be controlled, a risk which cannot be avoided. That is systematic risk. You cannot avoid it. It has to be there. Nobody, big or small investors, only great people, greatest investors like Warren Buffett, they have, people say that he has overcome systematic risk, which is very difficult for an ordinary investor to understand this. I feel that it is very, very, very difficult or next to impossible to control the systematic risk. It is non-diversifiable. You cannot diversify from here to another place. No, you cannot control. You cannot avoid it. So how, why such risk can occur? That risk could be because when the government increases the interest rates, can the companies avoid that risk? The answer is a big no. Then when there's inflation, prices go up, profits of the companies come down. Can companies control that? No, that is systematic risk, which cannot be avoided at all. Unavoidable, uncontrollable. You have to pass through that. You have to overcome that by either losing or by minimizing the risk. Okay, then we have unsystematic risk. Unsystematic risk is that risk which can be controlled, which can be diversified, and the loss can be minimized. That is unsystematic risk. So in stock markets, risks are there. Both systematic risk is there, unsystematic risk is there. So when you invest, keep in mind these things: the systematic risk and the unsystematic risk. We are not Warren Buffett's to control systematic risk. Agreed? Yes. But who knows? You will become one by investing, and it is possible. Don't give it up. At least you can be a good investor. At least you can be a good investor and make good money with your knowledge, experience, and the techniques, and of course the good returns. So I think now you're eagerly waiting for knowing why do stock prices go up. Right. The first point is, the foremost is, the stock prices go up because of not only growing sales in the last year, but even in the current year, the sales are going up. Last year, there may be some other reason. It is not that. Even this year, the company has reported good sales. Smart investors not only see last year's sales and this year's sales, but they also see what is the projected sale for this current year, the time to come. Is it the company going to sell more? And that they can understand by looking it into the economy. What is the state of economy? Now, can people think of having good business in theaters? No, because still the theaters have not been open for public. So investment into those companies is not a good idea. So the first thing, stock price go up is because of the growing sales in the last year and the current year, and also the projected sales. If that happens, people would like to buy those shares, and there's a demand for such shares goes up. And as I said, when more and more people demand a share, the price goes up, right? Or do I have to give you an example personally, and one more example in numbers? Okay, I got it. For example, suppose a company has reported 100,000 sales last year, and now it has reported 125,000 sales this year, and are likely to sell, and it is quite possible that the trend is going to continue for some more time in future. Then the stock price of that particular company will go up, right? Okay, there we go. The second reason, I repeat the first reason again, stock prices go up because of the growing sales. So when the sales price goes up, yes, the share price also goes up. The second reason why stock prices could go up is because the company employs or hires a great new CEO. The existing CEO has not been making a great impact. The new CEO, who is more dynamic, more knowledgeable, more experienced about the market, if he comes, people think that this new CEO will bring with him the new ideas, and those new ideas will take the company to greater heights. And I'm sure the share price will go up because the company has hired a new CEO by paying him some extra, and no company will pay a higher salary to a new CEO unless the company sees that the new CEO has the ability to take the company to the next level. That is what every company wants. That company, their company, to go to the next level, just as you want to go to the next level from BCom, from MCom to MCom, and from MCom to PhD. Every company wants to go to the next level. So the first point was growing sales. Second point was a new CEO was hired by the company, not fired. They fired the old CEO and hired the new CEO. Okay, right. The third reason could be when a new product is launched by the company. If you remember some time back, I think maybe you have bought an iPad. An iPad, when Apple introduced iPad in the year 2001 and 2002, the stock price of Apple went up. So it happens with any company. When the company brings out a new product which is, which has more better features, people go for that company and buy those products, and the sales go up. When the sales go up, earnings go up. When the earnings go up, what happens? The share price also goes up, up, and up. Right? Okay. So then we go to the fourth point, if I am not wrong. The fourth point is the new contract. When a company backs a new contract, then higher sales, big business. Companies get new contracts, sometimes overseas contracts. Overseas contract, like companies like L&T, they back overseas contracts. And when they get overseas contracts, that means more revenue, more profits. So naturally, the stock price goes up. Do you agree? Yes, because the demand for those shares will go up when a company gets a new contract within the country, or even for that matter, outside the country. Outside the country, foreign exchange. So it depends how much value the company creates by bagging new contracts, and they tie up new contracts and they get huge business, and that is what the company has to say. Actually, the government across the world give money in the hands of the people to make them use. The government wants people to use the money, buy things, because that lifts the stock market. That lifts the stock market. So when people buy only, the stock market goes up. That is what our finance minister has been doing. So they're giving money to the MSMEs to start the business, to make products available. So bagging a new contract will help, share prices to go up, right? Okay. Then the next point, the fifth point is that suppose the TV, national TV, say, for example, I don't know which TV channel I should say. Any popular TV channel says that um, this particular product is very good, and they give a rating of 5 on 5. What happens? 5 on 5 on a popular channel, share price of that company is bound to go up, because everybody is watching that popular channel and they believe that channel is giving good information. So definitely that gives a boost to the sales. A good rating of 5 on 5 is the fantastic thing for a company to progress. So the share price go up. Then the sixth point that I could give you is, when the company splits its stock, I think some of the students of commerce may be having an idea as to stock split. If a company has a share price of a very high value, people cannot buy it. And there cannot be liquidity in the market. Some of you may be knowing that MRF, for which Sachin Tendulkar is brand ambassador, MRF sells one share. It was selling sometime for 75,000 rupees. Now, I think yesterday it was some 60,000 odd. Can a small investor buy that? No. They have to split the stock into a lower denomination so that more and more people buy. So when this happens, when suppose tomorrow MRF splits its stock for one MRF share, if they give say 20 shares of so price, more number of people are holding the shares. That brings in liquidity, and that augurs well, not only for the market, but also for the company. It occurs well for the company. The company share price goes up. So when the company splits its stock, the market price tends to go up. Then another reason is some scientist somewhere in the world, even in United States or even in Japan, somebody says that if you drink this, you get immunity. And that particular product is sold by a company in Hyderabad. People throng to that company. People go and buy that particular product because scientists said that if you drink this, you will not have coronavirus. People are happy. I buy that, I drink it, and God forbid, I pray for all of you that none of you and your family get it. But the fact of the matter is, yes, when a scientist says that a product sold by this company is good and people will buy that particular product and that company's shares go up. And the result, you know, I don't have to tell you because now you are in line with me. All right? Okay. Then the next point number 8. Point number 8 is when a big investor like Rakesh Jhunjhunwala, or for that matter, very big investor like Warren Buffett, Peter Lynch in the United States, and we have so many people in India also. If they sell some of the shares of, say, Reliance or ITC or for that matter, Bank of India or State Bank of India, then others also try to buy that share. If they buy, others also buy, and the demand goes up because of the herd mentality. HERD, herd mentality. What is the herd mentality? If I buy, there are some other people who buy. Oh, X bought, let us go and buy. Let us buy. हम भी खरीदते हैं, चलो. बहुत से लोग खरीद रहे हैं, हम भी खरीदेंगे, चलो. Everybody buys. Result, क्या होगा? Prices go up. There, and that is the story. Okay, then one more point why stock prices go up is when a company X is taken over by company Y. The share price of company X goes up. The stock price of the company goes up when, and generally, the purchasing company proposes a deal, which is usually a windfall for the existing shareholders. And generally, the share price of that company also goes up. So we have seen some 9 reasons why do stock prices go up. How much time is there? Okay, still we have some time. Now we move on to the reasons why stock prices go down. It is easier for you to understand this because you have seen why do stock prices go up. The first reason is when large number of investors start selling the shares, people think, oh, something is wrong with that company. Let me also sell it. When the supply of that company's shares are more, the result is stock, there are not many buyers. When there are not many buyers, the stock price tends to go down. Agreed? Okay. All right. Then suppose the share price also go down when the stock prices of some other companies in that industry go down. For example, suppose the economy is going down, automobile sector goes down. When economy is going down, automobile sector is going down, good, bad, all automobile companies also are affected. It is not that just that one company will make good sales and the other companies will not sell more. No. If the economy is on the downturn, who will buy? And that was the case. But now slowly it is picking up, and that hopefully that will not happen. So when the prices decline, when other stocks in the same industry go down, this company will also go down. Right. So another reason why stock prices could go down is when your company is there in the market and a new company or another existing company brings out a better product than this company or your company, then that company's sales will go up, and this company, which has not brought a new product, will have a decline in sales, decline in revenues, and ultimately the share price. Okay? All right. Another reason of share prices going down is because when the sales are dropping because the company is not in a position to supply the products properly because of lockdown, or because of the lack of raw material, or because of strike by the company. So many reasons they are not able to supply the products. There's a shortage or supply is not there. What will happen? The company cannot sell. When the company cannot sell, sure, stock prices will have its impact. Then, when a top executive, who has been loyal to the company for a long time, suddenly decides to leave, what happens? The business is affected, because by the time a new executive comes and takes over, there is a disruption in the business activity. A great sales manager, is taken away by another big company by paying higher amount. By the time a new sales manager comes in this company, the sales are affected. It takes a while for a new, sales executive to fall in line with the business. So what happens? The sales of this company go down. And then another reason why stock prices could go down is, like, if Rakesh Junjanawala buys shares of a bank, the shares of that particular company, bank, go up. When the same person sells the shares of a bank, others also fall in line with him. Because people think, oh, that gentleman is selling because he is an experienced person. Something is wrong with that bank. Something is wrong with that company. Let me also sell. Herd mentality comes into picture and drop in, the share price. Right? Okay. Another reason could be there are analysts in the market. Just as you know, mm, there are analysts who give a grading to the finance companies, A plus, A plus plus, and all that. Companies are graded. When a company, if it is graded down, what happens? What happens? The share price goes down. So people, uh, when they are buying and holding, they start selling it. They don't buy and hold. They don't hold. They sell. In stock markets, these two things, three things you hear very often: buy, hold, sell. So people don't hold. Once a company is downgraded by some experts, then it is going to have its impact on the share price. And then another good reason could be, it may not be the most important, but it is a good reason, and that if a company loses a big customer who has a lion's share in the business, if that customer shifts his loyalty to another company, your company whose shares you are holding, that company will lose its value and it is going to sell at a lower price later. So these are the reasons why stock prices go up and why stock prices go down. When you buy and sell, you should give thought to these points. In spite of that, a good research is always important. And if you really want to start investing, it is going to be a very great thing. But before that, before you start investing your own money, don't do that. I request you to do something which, by that you don't lose anything, but you get experience. Do you like that? And that is, you can have a stock market simulator where it's a game where companies give you money, not in cash. Okay, they give you, say, 1 lakh rupees or 2 lakh rupees. They give you virtual money, but you have to buy and sell the real money, the real stocks. I'm sorry, the real stocks you have to buy. Then at the end of the day, you will understand what made you earn money or lose money. And this process goes on for some time. And if you want such companies' names where you can do stock simulation, I can tell you the names are moneybhai.com, moneybhai, MONEY, moneybhai, and then track invest, and then moneypot. So you can uh, have some experience by using virtual money, not from your pocket. As I told you, your money, whether it is your parents' money or your money, it is hard-earned money. You have to save every rupee, because like in cricket, a run saved is a run made. So a rupee saved is a rupee earned. Save money and invest it for a long time. And Warren Buffett says, Warren Buffett, one of the greatest investors, he says, remember two rules when you invest. Rule number one is don't lose money. And rule number two, he says, is don't forget rule number one. Okay. All right. So let me tell you one more point about Warren Buffett. Warren Buffett has 63 companies. He has 63 companies, and he meets the CEOs of these 63 companies twice in a year and tells them only two things. What are those two things? Two things are, remember, number one thing is, and maximize your shareholders' wealth. He says, remember, one point is the rule number one which CEOs should remember is maximize shareholders' wealth. This is the first point they should remember. The second point which the CEOs should remember is to remember the first point. Okay, so that was a great gentleman called Warren Buffett. I request you to read more about Warren Buffett and try to start investing, and that too with your own hard-earned money. Don't lose it. If you want me to read out some principles before we close, some 7 principles of investing, because I don't know how long should I continue, because I don't want to encroach into the other session of somebody else, which is not good on my part to do it. Of course, I would love to talk to you anytime. You can email me. My email ID is agnihotripodcast@gmail.com. And please listen to my podcast, like, share, and subscribe. More than that, put it in practice. Invest, make money, and enjoy that extra money with your family. Okay? All right. So before we close, let me tell you some good principles of investing. Number one, the first and most important principle is buy business, not stocks. Don't buy a stock of, say, XYZ company. If you are buying a stock, that's not correct. Think that you are buying a business. You are buying the business and you are the owner of that business. Not I purchase stocks and 100 rupees and when it will go up. No, don't focus on the stock. Focus on what the business does. What is that business? You are the owner of that business to that extent. If you have 100 shares, you are the owner of that company to that extent of 100 shares. So buy business, not the stock. This is the first and foremost important principle one should remember when you buy stocks. You are the owner. Behave as if you are the owner. Okay? Right. Some of the legendary investors, they follow this second principle. Love the business you buy. Love the business you buy into. Whatever business you have bought, you should love that business. You should know what is that business doing. You should know the naked truth of that business. Uncover that business. When you do that uncover part, you will understand the naked reality of the business. Love that business. Only then you should be able to understand, and then you will not make mistakes about it. Investing, just like an intuitive investor, is a fool's job. And you're all smart people. You will not do that. Never, ever. Then the third principle is invest in companies you understand that this company is good, not that somebody says. Invest in companies which you understand that company is doing a good business and it is creating value to the customers. And when the company creates value to the customers, your investment in that company as a stock goes up. So invest in companies you understand. Then the fourth point is find well-managed companies. The success of any company is in the hands of a good or bad management. The success or failure. If the management is good, if the management is taking care of its customers, if it is not only customers, if the management takes care of its employees and it's all the stakeholders, then the company will do well. So you have to check how well the company is managing its business. Is it taking care of all the stakeholders? Not shareholder, stakeholders. There are many people included in this group of stakeholders. So you have to check whether the company is managing well its business and whether it is able to convince, whether it is able to make all the stakeholders satisfied buying a part of that company. Okay, all right. And then don't stress over diversification. I think I should tell you about what is diversification. Diversification is uh, taking stocks from one company and putting it in some other company. Or diversifying your investment means putting stocks in different sectors. So don't stress too much on diversification. It is better to invest in 5 or 10 stocks, value stocks for long, than over diversifying, having 20 stocks in different sectors, different areas. No, it is difficult to manage. Value investors, wait, they should have patience. They have patience. They diversify their investments because that reduces the risk. So don't stress over diversification. Then another point, another principle one has to keep in mind is your best investment is your guide. If you have invested in 10 stocks, 1 or 2 stocks may be doing very, very good. So those 2 good stocks will definitely be a guide for you to follow your investment strategy in the remaining 8. So your best investment is your guide. Why? What decisions made you to buy that stock and you made profit in that? That investment is your guide. That will help you. And this last point, don't misunderstand me, because here you need to understand it so well. The point is, ignore the market 99% of the times. That means if you are a long-term investor, don't sell every day, buy, sell, buy, sell. Don't do this. So these are the principles one has to keep in mind while investing. I think I get some signals that my time is up. And I thank you all, ladies and gentlemen, for hearing me patiently for such a good time. And should you have any questions, you can ask. Thank you very much. I can't hear. Is it a question to me?
Okay.
Sir, switch off your phone, sir. Sorry. Fan, sir. Sir, fan switch off your phone.
Any questions?
If you want
Good
to ask
afternoon,
any
sir.
question,
Yeah, thank you, sir, for your excellent presentation. Yeah, lot of inputs you gave to our students. Yeah, thank you, sir. Thank you, professor. Wonderful lecture. And the first session is an excellent session. Yeah, thank you once again. Thank you so
You're
much.
welcome. Thank you so much. Okay, see you. Bye-bye.
Bye, sir.
sir, thank you, sir. Thank you for your blessings.
Thank you.
Thank you, sir.
Thank you.
Venkat, సార్ వచ్చినా
Sir, లేదు సార్.
రాచప్ప సార్ అని ఉంటాడు.
తెలుసు సార్ సార్ ఇంకా రాలేదు సార్. Good afternoon, sir.
So, good afternoon, sir.
Good afternoon, sir. Sir, how are you, sir?
I am fine. Thank you,
Sir,
Venkateshwar, sir.
Venkatesh, sir. Parliament, sir.
Yeah. Sir, give me 1 minute. I'll open the window so I
Okay,
can
sir.
have better lighting.
Dear participants, day 1 feedback form is posted in chat box. Please complete the process.
Hello, sir.
Yes, sir.
Sir, good afternoon.
Good afternoon.
Sir,
Can you see my slide, sir?
yes, sir.
And can you see my PDF file?
Yes, sir.
Okay.
Good afternoon, sir.
Good afternoon, Naresh Reddy, sir. Can you hear me?
Yeah, good afternoon, sir.
Good afternoon.
Yeah. Yeah, I am very much pleasure to invite you for this second session of the day. This session is totally dedicated to how to read financial statements. Even most of the investors in the capital market and the money market, before investing or before selecting particular security, they can go by the performance of the companies. The performance of the companies that are known with the help of reading the financial statements. So every company mandatorily they publish the annual reports every year. So quarterly reports also they publish. And according to that, there are so many number of facts and figures which are there in the financial statements. So what type of facts and figures that an investor must try to know out of these important and mandatory financial statements. So how to read these financial statements? So that is going to be explained by Professor Rachappa. Sir is from IIM Kozhikode, Kerala. So I want to take 1 or 2 minutes to introduce the speaker. It is my pleasure to introduce Professor Rachappa. So currently working as the professor in the Indian Institute of Management, Kozhikode. Prior to this, he worked in SEBI's National Institute of Securities Market, NMIMS, Mumbai, and University College of Commerce and Business Management, Usmania University. He has trained senior officers of SEBI, Indian Railways Accounting Service, Bharat Electronics Limited, CRISIL, and manages from 50 plus companies. He has also conducted forensic accounting training program for officers from capital market regulator. He has published many articles in the reputed journals, mainly in the area of earnings management. These are the articles which are published in international journals. So I welcome sir for this session. Thank you for accepting and giving time to us for sharing your knowledge with our audience. Thank you, sir.
Thank you. Thank you, Professor Naresh Reddy, sir. Yeah, so I have about 90 minutes of time. In this 90 minutes of time, my agenda is like this. Okay. I would like to talk on 7 things in this 90 minutes time. So it's very short time to do, how to read financial statements. But this is how, the non-accounting and non-finance, the executives and the participants learn. The one is, what are the financial statements? And what is balance sheet and how to read balance sheet? What is statement of profit and loss and how to read statement of profit and loss? What's cash flow statement and how to read a cash flow statement? So these are the 7 things I would like to do it. So in this 90 minutes time, so maybe first 60 minutes, 70 minutes, so I'll be talking. However, you have any question, anytime, so you can unmute and speak. So is that okay, Dr. Naresh Reddy? Can they unmute and ask the question?
Yeah, you can continue, sir. And lastly, you can give some 10 to 15 minutes for question answers.
Yes.
That is better.
So, that is fine. At the end also there, and also in between. So whenever they would like to ask a question or they have a comment, so that's okay with me. So they can unmute and they can ask the question.
Okay, sir.
So the perspective of doing, the how to read financial statements, why reading financial statements is important. As Dr. Naresh Reddy briefed in the beginning itself, there are two perspectives. The one is from the point of investor. So if you are in the shoes of investor, so you need to understand the performance of the companies and also the financial condition of the company to decide whether to invest or not to invest, when to invest, when not to invest, at what price to invest, at what price to sell, what price to buy, and what price to sell, and so on. So this is one perspective, which is called, we call, the investment perspective. So investors' point of view, investment analysis or equity analysis. The second perspective is a credit analysis. So this is from the point of the bankers or suppliers. So bankers, when lending loans, they need to understand the financial condition of the companies before sanctioning the loan. Similarly, the suppliers, when they are supplying goods and services on credit to their clients, so they need to understand the financial condition of their client because most of the times it is on credit. So these are the two perspectives. So equity analysis or investment perspective, and the second one is credit analysis. So this is from lending perspective. So let me start with the first one. So at the end of this session, so all of you should be able to answer these 7 questions. So I have been told that all of you are coming with non-accounting background. Am I right? Can you please respond using chart? Do you know using chart function? Can you please respond? I would like to know how active you are on chart. I was told that you all are non-accounting or non-commerce postgraduate students. Is that correct? Yes. So let me move on to the first one. Okay, so there may be 1 or 2 years commerce student. That's very good. But I was told that it is for non-commerce students. So that's the perspective. So there are three financial statements. When you say financial statements which are published by companies and are the major source of information, one is balance sheet, and second one is statement of profit and loss, and third one is statement of cash flows. So these are the three major financial statements published by companies, okay, published by companies annually, and they are one of the most important source of information for understanding financial condition of a corporate. Can you please respond on chart? How many of you are familiar with these? How many of you heard these about these three financial statements? Can you respond using chart? That's good. Navya Reddy, Mayank, that's good. Mayank, Jane, that's good. So Sri Durga, that's good. Okay, that's good. Very good. Supriti, Venkatasai, that's good. How many of you have not heard about these three financial statements? Can you please respond? Respond using chart. How many of you have not heard? Okay. No one. May I know, Kushi Sharma, how do you know about these financial statements? In what context you got to know about these three financial statements? Any one of you, can you unmute and speak? Can you please unmute and speak how you got to know about these three financial statements?
Hello.
Yes.
Good afternoon, sir.
Good afternoon. Please go ahead.
Yes, sir.
Venkat?
Yes, sir. It's me, Sai Srinivas.
Yeah.
Sir, I heard about these. As I'm from finance background.
Okay. So you are from. What did you study? What are you doing now?
Presently, I'm studying my MBA, sir.
Okay. So
Yeah.
very good. So you are in second year now?
Yes, sir. Final year.
Final year. Okay. So you studied in your first year course.
Yes, sir.
That's very good. Thank you for responding.
Thank you, sir.
Anybody else?
Good
How do you
afternoon,
got to know about these three financial statements?
Good afternoon, sir.
Good afternoon, Navya.
Myself, Navya Reddy, sir. I am from MBA second year from KGRIT College, sir.
Very good. So
I
you
am,
must have studied. Go ahead.
yes, sir. I studied from the degree based, sir, and inter based, sir.
Very good, Navya. Thanks
And
for your response.
thank you, sir.
Okay.
Hello, sir.
Jagdish,
Yes,
go
sir.
ahead.
Good afternoon, sir.
Good
Yes, sir.
afternoon.
I am pursuing MBA, sir, second year from MVGR College of Engineering, sir.
Okay.
I know financial statements from basic inter, sir. Inter, my group is MEC, sir.
Oh, very good, Jagdish. Very good. Very good. What did you study in undergraduation, Jagdish?
Sir, BCom, sir.
Okay, very good. So you have been studying it for 5 years. That's good. Now, I would like to know, may I request, please, some of the participants, those who are not doing MBA or MCom, can you please come online and say one or two words? How do you know or you don't know?
Sir, good afternoon.
Yes, when I go ahead.
Yes, I'm completed MCom, sir, first PG.
Okay, from which college, Vinay?
Kakate University, sir, Varangal.
Very good. 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 Very good, Vinay. Thanks.
Graduation in
Anybody
BCom,
else?
sir.
Okay, that's good, Vinay. Good. So you have done BCom and you are doing MCom. So
MCom, sir.
that's good, Vinay. Thank you. So
Thank you.
anybody else? I would like to listen. Is there anyone who has not?
Sir,
Yes. Rajya Lakshmi.
I am Ravalika, sir.
Oh,
Yes,
sorry.
sir.
Pravalika. Huh. Yes. So go ahead. Pravalika, your voice is breaking. I think there is a bandwidth problem.
Hello.
Shaikh, you can speak.
Good afternoon, sir. It's Firdaus Kalyeri.
Okay, go ahead.
I know
Firdaus.
all these topics from my intermediate, sir.
Oh,
As a
very
senior
good.
student.
Very good. So
And
very
I
good.
did my degree in BCom and now I'm MBA, sir. So I have
Okay, that
7 years.
that from which college are you studying, Firdaus?
The Kakatiya University Arts and Science College, School of Management.
Okay, that's good. Thank you.
Thank you, sir.
Okay, so now what I understood from this, the brief discussion with you all is that those whoever spoke, so they are from either commerce or finance background. And I assume that most of you are coming with accounting and finance background, right? So I have to do slight change in my talk. Okay. The reason is now I would understand that you all are from accounting and finance background because I have not heard anyone who did not, know about the financial statement. So all of you say that you are familiar, at least you are familiar with financial statements. Is that fine? Please respond using chart. So my
Yes,
presentation will be based on assuming that you are familiar with the financial statements, right? Please respond using chart. Okay. So it's very important to understand, to whom I am talking. So when I was doing my PPT, I was told that this is for, the non-accounting or non-commerce student, something like that. But now, so I'm happy to know that either way I'm happy. So I'm happy because I know with whom I'm talking, right? So I can speak. All right. So Kiran Kumar, you say that, please start from very basics. So can you please introduce yourself? Kiran, no problem. Can you speak? I can even understand Telugu also.
Good afternoon,
Okay.
sir. Sir, can you hear
Yes,
my
I can
voice?
hear you, Kiran.
Good afternoon, sir. My name is Kiran Kumar from Visakhapatnam. I'm doing my MBA first year from Andhra University. So the problem is I have gone through this response, financial statement, balance sheet, and everything, but I don't know the very depths of that. So
All right.
whatever the lecture you have prepared earlier to present to us, please go with that. No need to.
All right, Kiran, I will take care. Don't worry.
Okay, that's it. That's the only short request I would like to present in front of you.
That's good. I will take care.
Okay, thank you.
Okay. So let me go to these three financial statements. So as you have done, the MBA first year or, the BCom with varying, background, maybe engineering or, the art, science, and most of you are with accounting background. So let me go to, the first one, this is about the three financial statements. So let me go to balance sheet. I'll give basic as well as how to read balance sheet. So the balance sheet is a statement of sources of money and application of money. What are the different sources of funds? How do companies generate funds? And the second one is, how are those funds applied or used in business? Okay, it's the sources of money and sources of, and application of money that indicates how those funds are applied, deployed. Okay. So accordingly, the statement shows all the details about equity, liabilities, and assets. Equity is a source of generating funds, and liabilities are also source of funds. So equity and liabilities are sources of money to the company. So we are doing it from the point of company, and assets are nothing but the application of funds. The how funds are applied. Hence, the statement can also be called as statement of assets and liabilities and equity. So it is a basically statement of assets, liabilities, and equity. So when you say assets in the balance sheet, assets are classified into current assets and non-current assets. Kiran Kumar, you say that you don't have the accounting background in your graduation, so you can note that the assets are broadly classified into two categories: current assets and non-current assets. The current assets are short-term assets; they are nothing but short-term, and non-current assets are long-term assets. Can you give one or two examples in the chart, please? What are the examples for current assets? What are the examples for current assets? Current assets are you typing? Can you give one or two examples for current assets? Inventory, yeah, that's good. That's good. Debentures is not current asset. Okay. So the most popular current assets, that's good. Cash, marketable securities, that's good. Trade receivables, that's good. So I will show you the balance sheet. So they are broadly classified into current assets, short-term assets, and non-current assets are long-term assets. The assets which are going to be used for more than 1 year. They're going to be used more than 1 year, and the current assets are short term. They are going to be used, they are going to be converted into cash within 1 year from the date of balance sheet. Okay, and the liabilities are classified into broadly two categories. Number one, current liabilities. The liabilities are the obligations of the company. They have to be discharge in 1 year period or less than 1 year period. So they are called current liabilities. And these liabilities, which are going to be discharged after 1 year in long term, so they are called non-current liabilities. So, and the third category is equity. So equity is nothing but the owner's funds. What do you call to owners of the company? How are they known as in the market, owners of the company? Can you please respond in the chat? What do you call owners of the company? Equity shareholders. equity shareholders are the owners of the company. So maybe retail or promoters like Mr. Narayan Murthy or Mr. Ratan Tata is a promoter equity shareholder, but you and me also can buy the shares of the companies. Any company, State Bank of India or Infosys and so on, even they can become owners of the company. So the funds which belong to the owners are called equity funds. So they are broadly classified into capital. This is the contributed capital, capital contributed by the owners, and other equity. Other equity is nothing but the accumulated profits of the company after paying dividend. Accumulated profit. Okay. So now I will take you through balance sheet. So before that, do you have any question from this slide? Any question do you have? So you can unmute and speak. You don't have to type. You can unmute and speak. So no questions. All right. So let me take you to balance sheet now. So you all know the Colgate company. Please respond using chat. Do you all know Colgate Palmolive India Limited company? What are their products? Can you please respond? What are the products of Colgate? Colgate Palmolive India Limited. Do you use Colgate? Toothpaste and brush,
Yes, sir.
oral care, that's good. That's good. So Firdoskal, how do you pronounce your name? Firdos.
Yes, sir.
Yeah. So Firdos, that's good. So we all are, the frequent users of this company and the products of this company. So I have taken this company to make you understand how to read balance sheet, income statement, and cash flow statement. So let's take, this is what I was showing, here are the assets. This is prepared on a particular day, the most recent balance sheet of Colgate, published just few days back, right? So in the month of June, it was published. So they have assets. Okay, so assets are broadly classified into non-current assets. So here are the non-current assets. Okay, and the examples for non-current assets are properties, plant, equipment, intangible assets. Can you please unmute and speak? Give some examples for intangible assets. Any one of you? Anil, go ahead.
Copyright, sir. Patents.
Good.
Copyright, sir.
That's good.
Goodwill.
Very good.
Trademarks.
That's
Trade
good.
names.
So good. Good. Very good.
Franchises.
Very good. Can you name
Machine
the
and buildings.
company? Can you name the company which has got maybe very high intangible assets? Can you please respond using chat? What kind of companies have normally high goodwill and patents? Okay, so Durga says Reliance. Any other company?
MACD. MACD. Franchising company.
Why do you think so, Anil?
So it's a high value and
Okay.
everyone are using it now, sir.
Okay. Fine.
So the consumption of MACD is very high due to all the students and college going students are using it.
Okay. All right.
Buying everything it, so it's a high value, high goodwill, I think so.
That's fine, Anil. Thank you. So,
Okay, thank you.
so some of the companies, like technology companies, entertainment companies, communication companies, tech companies, TEC. The tech companies have high intangible assets. Technology company, example, Facebook. What is the real asset of the Facebook? Is it visible? No.
Yes, sir.
Entertainment company, you take an example of maybe, I don't know what is the company name, Rajamouli's company, the production company. So which has produced, the great movies like Bahubali 1 and 2. So are their assets tangible? No, they are intangible assets. So now the Bahubali movie is captured in a pen drive, or it is captured in a small CD, or it is there somewhere online in YouTube. It is not visible. And similarly, communication companies, take an example of Airtel, or take an example of Vodafone. What is the biggest asset of these companies? 3G, 4G, and 5G. So are these assets tangible? Please respond using chart. Are these assets tangible in case of three companies? I have given an example of Facebook. I have given an example of the Rajamouli production house. And the third example I have given is telecom companies. Yes, so these are the three companies, three sectors which are known for intangible assets. Which assets are safe, tangible or intangible assets?
Intangible
Which assets are safe?
Intangible assets, sir.
Navya, so why do you say intangible assets are safe? Why do you say they are safe, Navya? Is gold safe or equity shares? Among these two, which one is safer? Can you please respond using chart, all of you?
What is
Which
the
one is
question,
safer?
sir?
Is it gold or
Equity safe. Yeah.
Which one is safer? Please respond.
Sir, once again
Equity safe.
question. Sir, once again question.
Among gold and equity shares, among these two, which one is safe investment? I don't see response from all of you.
Equity share.
Equity share. So you should check with your parents, Firdos, and Navya. Just ask if your family member is there around, if you are attending from your home, quickly ask them. I don't mind waiting for 1-2 minutes. I'm surprised. You have to be practical. You ask, please, Firdos, are you at your home?
Sir, stocks are like risk-free assets, no, sir.
Or check with one of your family members.
Hello?
Sir, if we invest in gold, we won't get the same rate as we purchase now. In future, we won't get the same price, right, sir? If we invest in equity share, we can increase our amount.
Firdos, what was my question? Did I ask which asset gives higher return or which asset is safe?
Safe. Oh, sorry.
Sir, gold is safe.
You need to understand the question, please. You can't answer what you like. Yes,
Sir,
I
I think
agree
gold
with you.
is
Absolutely, Anil, Navya, Firdos. Thanks for being active. Right? Thanks for participating in this session. I completely agree with you. The equities give higher return, very high returns. But are they as safe as gold? That's my question.
No, sir. Gold is safe investment. Equities have fluctuations. It has an inflation, everything.
Now going back to my original question. So which one is tangible and which one is intangible among these two?
Gold
Sir,
is tangible,
gold
sir.
is tangible, sir.
Yeah, so,
Equity is
so
intangible.
that's fine. That's good. So please respond using chart, all of you, Anil, Firdos, and others. Now I'm revisiting my question. So among tangible and intangible assets, which are safe assets? Which are safe assets, reliable assets? Is it tangible assets or intangible assets? Don't say gold. Is it tangible or intangible assets? Let's speak in accounting language.
Sir,
Okay.
in my opinion, there is no such thing like safest asset.
So that's
Because
good. So that's good. So let's move on. That's good. Thanks for your responses. So here are the examples for current assets and non-current assets. And here is the equity, right? So the equity is in the form of capital and other equity of Colgate company, and the liabilities are there. The liabilities are broadly classified into non-current liabilities and current liabilities, right? So, and then total of equity and liabilities. So this is about the balance sheet. Now, how to read the balance sheet? So let me take you through. Here are the 5 questions. So very simple question. So I have presented in the form of question, please. When you are reading balance sheet, so what are the questions you should answer? Will you be able to find out what is a major source of assets? What is the major source of funds? What is the major asset? What is the value of the company? And what's the short-term financial condition? What's the long-term financial condition? Can you please respond among, with the help of chart, which question is the most important question among these 5? Can you respond please on 1 to 5 questions? Which is the most important question? Can you please respond in the chart? 3, value of the company. That's good. Anil, you would like to know value of Colgate company on 31st March 2020. That's good. That's good. So I have to get response from all. You have to be active. So you all are young, at least maybe you are, I'm quite old, if I have to type, and all, so I find it difficult. That's good. So value of the company. So how about others? Major assets, I think. Okay, that's good. That's good. That's good. All right. So now we will answer these 5 questions. Okay. With the help of balance sheet. Is it a good exercise? Can we go to balance sheet? Did you like these 5 questions to be answered based on balance sheet? Please respond. Did you like it? Did you like? Only 5 things, very specific. It's very simple, I would like to know what are the major assets. Let's go to balance sheet. Okay. So here are the assets. Can you tell me these are the amounts in lakhs? Here are the assets. From this list, which is the biggest line item? Which asset is the biggest one? So 1000, this is the biggest one, please. Plant, property and equipment is the biggest asset of this company. Do you agree with this? It is about 1,122 crores is the biggest asset of this company. So do you all agree with this? The biggest asset. Okay. And now let's move on. Is it a reliable asset? Is it a better asset compared to the intangible assets, compared to account receivables? Is it a reliable asset? Please respond. Plant, properties, and equipment. Is it a good quality asset? Please respond. That's good. I would like to tell you one of my investment story. I was in Mumbai, so I spent about a decade in Mumbai. So after working in Usmania University, I left Usmania and joined some organization in Mumbai. So one of my friends, in the local train, he convinced me to invest in one company. So he said, the stock was traded at 40 rupees. So he said, I should invest in that company. I said, will I get, some 10%, 20% return annually? He said, so what I was talking, so I would get 100% return in 1 year. So within 1 year, my investment would become double or triple. So I bought the shares of that company at 40 rupees. So later, after 2 or 3 years, I invest for long term, not for 1 day or 1 month or 1 year. So today also I'm holding those shares. I'm talking this 2009, about 11 years back, right? So I bought the shares at 40 rupees, and after 3 or 4 years, I was continuously tracking. What was the stock price? It has come down to 25 paise. From 40 rupees, the stock price has come down to 25 paise. Oh, so I got stunned, so I was shocked. What happened to this company? Let me see the balance sheet of that company, because I teach balance sheet. So I research balance sheet. Everything I do only balance sheet. So what happened? There I realized that 90% of their total assets are in the form of intangible assets. Can you get bank loan with the help of intangible assets? Can you please respond using chart? With the help of intangible assets, can you get bank loan? Please respond in the chart. Can you get easily bank loan with the help of intangible assets? Sri Durga, which bank it is? Please tell me. Sri Durga, which bank will give me the loan based on my reputation, my goodwill? I'm working in IAM. I have a lot of goodwill. Will I get loan? Without, my salary certificate, without security, will I get loan? Durga, you have to respond. Which bank it is? Don't tell this name of the bank to the Vijay Mallya. Otherwise, immediately he will come back to India. Sri Durga, are you there online? Can you unmute and come online?
Yes, sir.
Sri Durga, don't tell this name of the bank to Vijay Mallya. You know Vijay Mallya?
Yes, sir.
So otherwise he will come with his reputation and they loot the banks. Okay? So it's difficult, Sri Durga. You should understand that it is difficult to get loan with intangible assets, because bank doesn't trust unless you are a political leader. Isn't it, Durga?
Yes, sir.
If you are a big political leader working for either some ruling political party or the opposite political party, and then you go to bank, so you will get the loan. But if you are a normal person like your friends and me, it's difficult to get loan because bank doesn't trust, doesn't believe in intangible assets. But you go to bank with some land and building and with car, you will get loan. Okay, that's good. So the major asset is property, plant, and equipment. So this is a good company. So what's the major source of fund for this company? Which line item is the biggest one? Can you please respond using chart? Which line item is the biggest one from this? Can you name? Oh, I have to take it from here. Which line item is biggest one in this? If you have bandwidth, please put on the camera so I feel active to see some of you online. I feel like physical class, right? So if you have the extra the bandwidth, you can do it. So which is the biggest line item? Can you please respond either through
Can you
speaker?
repeat the question once again?
Yeah, so the Navya Reddy, I am asking, which is the major source of funds for this company? Which is the biggest line item on the liability side? It is other equity is the biggest one. Look at among all this, other equity, that's good. So Yeshwa, that's good. Sandhya, that's good. Other equity is the biggest one. It may is the major source of funds for this company. Means this company is making profits and it is using resources for reinvestment. So can you hear me all? Anil, can you hear my voice? Yes, sir. So there was internet was slow at my office, so I thought whether it's proper or not. Fine. So the major source of funds, which one it should be? Which one is safer? Are borrowings are safe funds or equity funds? Please respond in the chart. Think for a while. If you are running a company as a manager, which funds are safer and risk-free? Which funds are safer? That's good. So Sri Durga, Mayank, that's good. Yashwa, that's good. I appreciate your active participation in the session. That's good. So very good. Good. So I can make out you all have the good background of the accounting and finance. So I'm happy. So you are able to read. Right? So why borrowings are risky? Can any one of you explain why borrowings are risky? Can one of you explain why? So those who did not speak so far. I want someone who did not speak so far to unmute and explain why equity is safe.
So because in equity shares, the company doesn't have to pay them.
Very good, Gracie. Very good.
If they're not earning profit, they're not supposed to pay them. But
Very
if you
good.
take a loan, but you have to pay an interest on regular intervals.
Very good, Gracie. Can you introduce yourself? What is your background, Gracie Victor?
Sir, I am a PG student.
Oh, very good. All the best. That's good. So I would like to ask you all. So do you agree with Gracie? Please respond. Do you agree with Gracie that the equity are the risk-free fund? So in case of Colgate, it's a safe company because that's good. That's good. So we all are on the same board. This is how you can study the major assets and major liabilities of the company. Now, what's the value of this company? This is the third question. What's the value of this company? How do you find out the value of this company from the balance sheet? Can any one of you? What is the value of the company? Many of you have written value of the company is an important indicator. Okay, I will tell you. The value of company is Sum of total equity is the value of company. This is the value of company on 31st March 2020. The total of equity is nothing but the value of the equity. It's 1594 crores. For the year ending 2020 March, and whereas previous year the value of the company was 1446, right? Venkatasai, why are you giving formula? It's readily available. Did I tell you any formula, Venkatasai? Can you please come online? Are you there? Venkatasai, why do you have to apply formula? There is no formula. There is no need of formula. Kiran Kumar, you said you are coming with an engineering background. It's very simple. It's readily available. Tell me, finding out the value of the company, is it very difficult or very easy with the help of balance sheet? Please respond using chart. Now tell me, is it very difficult or very easy? It's there. Any balance sheet you take, any balance sheet on this earth, there is a total equity information. There is a total equity information. So you use that. That's nothing but the value of the company according to balance sheet. Right? Okay. That's good. That's good. So now the fourth question is the short-term financial condition, so which is also called liquidity. You can check the ratio of current assets to current liabilities. Please calculate the ratio of these two, current assets divided by current liabilities. I will take you to my, the PPT. So there I have done some calculations. So major assets are property, plant and equipment and cash equivalents. So the major source of funds are, the first one is other equity and second one is a trade payable. So the value of the company is also known as net worth. It is 1594 crores, right? And the short-term financial condition, so you can capture with the help of current ratio, which is nothing but current assets upon current liabilities, right? Current assets upon current liabilities. So the current assets of this company are, when you take from the balance sheet, you all know how to take current assets and current liabilities from balance sheet. Am I right? Please respond using chart.
Yes, sir.
Yeah, so when I take the current ratio is, the 1.16 is to 1. It means for every 1 rupee of obligation, financial obligation, the resources available are 1.16. The computation is easy. You all are coming with accounting and finance background, right? But how do you perceive? Is it enough or not? Please respond. Is this current ratio enough to meet short-term liabilities or not? Can you please respond in the chart? Is it good enough? Yes or no? Is this current ratio enough to meet short-term obligations? Okay, that's good. So it means if the estimated expenses are 1 rupee, 100 rupees, and in your pocket you have 160 rupees, isn't it enough? Okay, it's enough. That's good. Now, let me take on to the last one, long-term financial condition of the company. Long-term financial condition is, you can capture with the help of ratio of liabilities to the total assets. Total liabilities to the total assets. So in case of Colgate, it is about 39%. Right? Is it higher or lower? Are liabilities of this company higher or lower? Is this 39% liability of total assets? Is it higher or lower? Can you please respond? Okay, so it depends. It's difficult to say is it higher or lower. For example, if you score, the 70 marks in an exam, is it higher or lower? It depends on how your friends have scored in the exam, isn't it? If your friends have scored less than 60 marks, 70 marks is high, isn't it? So if your friends have scored 90 marks, many of your friends and classmates have scored 90 marks, you will say it is low, right? It also depends on how hard you have worked for the exam. Let's say without working hard, or what do you call in your student language, 2020, you will read just one day before for an exam but scored 70 marks. Now tell me, one day preparation, 70 marks, is it higher or lower? Is higher or lower? It's higher, right? So you work, for 365 days. You work for 365 days, but you score only, the 40 marks. It's lower, right? That's good. So that's good. So this is how, what you need to do is, you need to find out, you need to judge, is it higher or lower? Let's say I'm going at a speed of, the 45 on my bike. Is it high speed or low speed? Can you respond? 45. In code, I'm driving at 45 speed. Is it higher speed or lower speed? Respond. You don't want to comment on my, the bike speed. That's good. So that's good. If my children are sitting on my scooter, they say, what a boring driving. If I'm driving my car at 40, 45 speed, my daughter says, Papa, please take fast. It depends on the risk-taking capacity. I don't want to take any risk. So I drive at 40 speed, right? So my kids don't know what is risk. They want me to drive at 80 or 90 speed, even the scooter and bike. So all that I'm trying to say is whether the liabilities are lower or higher depends on the risk appetite. How much risk you can take. If you can take more risk, you can go for more liabilities. But you can take less risk, you can afford less risk, you have to go for lesser liabilities. So do you all agree with me? Higher risk-taking capacity, higher the speed, higher the liabilities. Right? Lower the risk, lower the speed, and lower the borrowings. My son, even if he is, the riding cycle, he goes at, the 30, 40 speed in the downhill. Right? I say, what is this? He says, it's normal speed for him. Cycle going at 40, he says normal speed. Because, he would like to take more risk. Right? It's very risky ride. All right. So now, do you understand the interpretation part of long-term financial condition? Is it higher or lower? It depends on the risk-taking capacity. Okay. So can we go to now income statement? Any questions? Can you please respond in the chat? Are you there behind your pictures? Your photos, I assume that you are there. Okay. Fine. So if there are no questions, let me quickly take you through, the income statement or profit and loss account. I don't have to tell you that it is also known as revenue and expenses, and it is prepared for a specific period, right? It's been prepared for a specific period, and it consists revenues like operating revenue and other income, and expenses like material expenses, employees expenses, and finance expense and other expenses. And the difference between profit is equal to revenue minus expense, right? So now let's take up 5 questions. So when you have to read income statement, when somebody, that's good, Durga, very good question. So account has debit and credit, whereas the statement doesn't have debit and credit. So we call statement, right? Income statement of Colgate company, I will show you. Here is an income statement. Can you see anywhere debit and credit? Sri Durga, can you see debit and credit? Is there left hand, right hand side?
No, sir.
Left side and right side?
No, sir.
So I call it as a statement. So if there is left side and right side, and you know the format of an account, right? There's a particular column,
Yes.
amount column, debit, credit, and so on. So then it becomes an account. So I'm using the word statement because there is no debit and credit. That's very good question, Durga. So let's see now how to read. These are the 5 questions to read, the income statement. What the major sources of revenue, major expenses, what's the profit margin, what's return on investment, and what's return on equity. Are they important questions? These are the questions you should answer when you are reading an income statement. Right? So are they important questions? Please respond. Do they help in understanding the performance of the company, financial performance? Yes or no? Please respond in the chat box. That's good. That's good. So let's move on to the first question. So what is a major source of revenue? So in case of Colgate company, so the major source of revenue is operating income. Operating from their day-to-day business, they generate 99% of sales revenue, and other income is only 1%. Other income is in the form of, in case of Colgate company, rent received, interest on their fixed deposits, profit on sale of investments. So these are the other income. Which income should be higher? Should it be day-to-day business? Which income should be higher? Should it be income from day-to-day business or other income? Respond in the chart. Which one should be higher? Which one is a good indicator of sales revenue? Navya, why do you say other income?
Operating income.
Operating income, that's good. That's good. So operating income. Somebody has written, the other income. No, please correct it. It has to be operating income. For example, you are doing MBA finance. Should you score good marks in finance courses or non-finance courses if you are majoring in finance? If you are doing, having a major of finance, shouldn't you score more marks in major courses? Yes. So in your core business, you should have more revenue from your core business. So is Colgate doing good based on this operating income of 99%? Is it doing good or very good or weak? Please respond in the chart with the first question. Is it doing good or very good? 99% of their sales revenue is coming from core. What are their major expenses? So here are the two major expenses. The one is cost of goods sold is 42%. And selling and general administration expenses, 31%. Okay, so the third one is their profit margin. So I have taken these expenses as a percentage of sales revenue. It means 42% of the expenses are for the manufacturing, right? And 31% is for their advertisement, for sales commission and administration. If at all, can you please think of one question? I want you to think. Take 1 minute time. If you are the manager of this company, if you have to cut down the expenses, which expenses you will try to cut? Is it cost of production or administration cost? Which cost can be cut down easily? That's good. So I appreciate, that's good. Administration. Because by cutting the administration cost, if you cut the admin cost, does it affect the quality of Colgate paste? If you cut administration cost, does it affect the Colgate quality? That's good. So you are able to understand, the connect, the ratios to the business product which you use every day in the morning. But what happens if you cut the production cost? It may affect the quality of Colgate, isn't it? It may affect. If you try to cut the production cost, it may affect the quality of toothpaste. Yes or no? Okay, that's good. So that's good. So the third one is the profit margin ratio. So this company is making 18% profit on sales. It means for every 100 rupees they are selling in the supermarket or from their company particularly, so they are earning 18 rupees profit. 18 rupees profit. I think it is good percentage, isn't it? Do you agree with me? It's a good percentage, isn't it? 18 rupees out of 100. It's very good. That's good, Ibrahim. That's good. And their return on investment, this is nothing but the profit divided by total assets. Profit divided, I have taken average assets in the ratio, right? So profit divided by total assets is 32%. It means for every 100 rupees they are investing, company is earning 32 rupees annually. Is it good or very good or excellent in terms of finance? Please respond. Is it good or very good or excellent return? What do you think in your view? That's good. So finally, what about this? Return on equity. This is profit divided by equity funds. The equity funds belong to owners. So they are giving 54% return on equity shareholders investment in the company, not in the capital market. Okay, not in the capital market. Please respond. Is it good or very good return on investment of equity shareholders? 54% per annum for every 100 rupees return. 100 rupees of investment, equity shareholders are earning 54%. Is it good or very good? 54 rupees on every 100 rupees. Okay. So any questions? So before I move on to the final statement, cash flow statement. Anything? Any comment, please, so far? You can unmute and speak. Please let me have 1-2 minutes of break. Meanwhile, when you are speaking, I can have a break of 1 minute. Can you please comment on your learning so far you had? You have to speak. All right. So, yes, so it's a direct one. It's a direct expense. Fine. Let's come to the final one. Statement of the cash flow statement is a statement of cash receipts and cash payments. All cash inflows and outflows are part of this statement. Cash receipts and payments. And these cash receipts and payments are classified into 3 categories in cash flow statement. In cash flow statement, number 1, so it's operating cash flows, operating cash inflows, so which are related to day-to-day operations. And investing cash flows, the cash flows which are related to long-term assets. And the financing cash flows, the cash flows which are related to the fundraising activities. Now I have questions to ask you. Which cash flow is important for survival of the company? Cash flow from which activity is important for survival of the company? Can you respond in the chart? Yes, Khushi Sharma, you can speak. Khushi Sharma, you have raised the hand. You have any question? Okay, that's good. So operating. Which cash flow indicates the growth of the company? Please respond. Which cash flow indicates the growth of the company? Which cash flow? Nikita, please select one of these 3. Shirisha, this is not financing, it is investing. The more investment company makes, the company is investing more money, then there will be more growth, right? Investing activity. That's good. That's good. So now let's move on to the how to read. So I have taken only 3 questions to read the cash flow statement. They are very important. I have taken 5 for balance sheet, 5 for income statement, and 3 in case of cash flow statement. So after this session, so today night, before you forget, you should take out one company's financial statements and answer these 13 questions. Will you do it? Will you attempt to answer these 13 questions? Okay, that's good. So what is the major source of cash? You should identify among 3, A, B, C. Which one is the major source of cash? Which is the major user of the cash? And are there sufficient cash flows from operation for investment, interest payment, and dividend payment? Are these questions good to understand about the cash flows of the company? Will you be able to understand something about the company if you answer these 3 questions? So now let's go to cash flow statement of the company. I will take you to cash flow statement to address these three questions. Major source of cash. I will take you to cash flow statement. Here is a cash flow statement. Cash flow from operating activities heading, this is A. It's about 900 crores or cash flow from operations. And this company has used about 18 crores into investing activity, and this has used about the 851 crores in financing activities. Okay, it's paying a lot of dividend. Now please tell me which one is the major source of money in this company. The major source of funds is cash flow from operations. Is it a good indicator? Please respond. The major source of cash inflow is cash flow from operations. Is it a good indicator? That's good. That's good. The second one is, what is the major application of cash? Okay, so they are using cash for repayment, that is dividend payment. So I made a small error there. Okay, so they are using cash for payment of dividend. This company is using cash for payment of dividend. Is it a good indicator? Please respond. It has used about 700 crores for payment of dividend. Is it a good indicator? Yes, payment of dividend. That's good. That's good. And the third and final question you should answer is, are there sufficient cash flow from operations for investment, interest payment, and dividend payment? The cash flow from operations of this company are about 900 crores. And investment requirement is 19 crores. And dividend requirement is about 700 crores. The funds available are about 900 crores. And their requirement is only about 700 crores. So can I say yes? This company has sufficient cash flow from operations to meet their investment requirement, interest payment requirement, and dividend payment. So how do you rate this company based on cash flows on 1 to 5? 1 is for weak cash flow condition and 5 is for strong, the good cash flows of this company. Colgate company, how do you rate? 1 to 5. How are the cash flows of this company? Can you respond using chart? Is this company doing good? This company's major source of cash inflow is cash flow from operations. And they are using cash for payment of dividend. And it has enough cash flows for investment purpose for payment of dividend. Okay. And this is about cash flow. And what about based on the performance on 1 to 5 point scale? How is it performing? Colgate company, how is it performing on 1 to 5? 1 is for the poor performance and 5 is for very good performance. How is it performing? Okay, that's good. So that's good. So this is about how to read balance sheet, how to read the cash flow statement, and how to read income statement using Colgate Palmolive company. And now it's time for only easy questions first, then after that you can ask me the difficult questions. So you have any question, so you can ask me easy question or even the difficult questions also fine. So I thought first I will take only easy questions and later I will go for difficult.
Yeah, any questions from participants?
So, okay, all right.
So you already clarified so many doubts.
So I was trying to make them, involve them, so that so I don't feel sleepy. They also don't feel sleepy.
Yeah.
So these are the challenging times. So we have to get used to this. So I hope you had some learning from these 13 questions. Okay, so fraud in the financial statement, how to check? Mayank is asking, Mayank, how to check fraud in the financial statement? So I'm typing here 3 models which you can apply. One is Benford model is one, and second one is Danish model, and the third one is a triangle approach. Okay, triangle approach is the third one, but these two, the Benford and Danish model, which I have sent it to everyone. Mayank, could you see those 2 models? Yes, Mayank, are you there? So you Google them and try to learn about these 2 models. Benford is actually physical science, but it's not that difficult, if you spend some time. These are the 2 models which are used by, the auditors. So when they are evaluating the possibility of fraud in financial statements. Okay. So because of time constraint, I can't take it in detail, but these are the models, you can check with my name also. I have papers, the published on Benford model, Danish model, so based on Indian BSc and NSC companies. Okay. So cash and cash equivalent. So Navya, it is bank deposits are cash equivalents. Bank deposits are also treated as equivalent to cash. And savings account bank balance is treated as equivalent to cash. I hope it is clear now. Now we are ready.
Yes, sir. Thank you, sir.
Yeah, thank you, sir, for your wonderful session.
No, I should thank for connecting me to Usmania University, after a long time. So I'm really excited to talk to, the from people, participants from, the Telugu state and from other states as well. So, because of this pandemic situation, so I'm, happy to interact with all of you. So otherwise, I'm in Kerala. I could not travel to, my Telugu state in last, 9 months. I couldn't travel. So today I'm happy to interact, with you all, so I'm feeling little like, I'm in Hyderabad or Warangal or Mahbub Nagar, Venkatesh. So I worked in Mahbub Nagar for 1 year. So,
I sir. Yes, sir.
So I'm happy. Naresh Reddy, sir, thanks for
I'm
giving me
very happy,
this
sir,
opportunity.
for your time, your presence, your presentation, your answering everything. Our students also satisfied very much because they are posting in the chat box. So they are very happy with you. I am extremely happy with you. I know your skills, knowledge, presentation, etc. So thank you, sir. Thank you for your wonderful session. Thank you once again.
Fine, sir. Thank you, Naresh Reddy, sir.
Thank you.
Thank
Have
you.
a great day, sir.
We are following your footprints, sir, in Palava University.
Sir, sorry, Venkatesh, sir.
We are following your footprints, sir, in Palomar University.
Oh, yes, great, great. So very good. So looking forward to meet you sometimes in future in Hyderabad or Mahbub Nagar.
Thank you, sir.
Fine, sir. Can I take leave, Naresh Reddy,
Yes,
sir?
yes, sir. Yes, sir. Thank you, sir. Right.
Thank you, sir. Thank you very much.
Yeah, please take 10 minutes break. The next session will begin at 5:10. The other resource person is also waiting. So take a cup of tea or water, whatever you want. Thank you.
At your home or at your place.
Yeah, it's respective places. They are also not in a position to move here and there.
Dear participants, I posted day 1 and day 2 feedback form in the chat box. Those who are interested to fill, you can fill. In YouTube is also YouTube, and today feedback form will be posted in end of the session. Naresh sir.
Yeah.
Sir is joining, sir.
Admit ain't, huh?
Yes, sir.
Okay. So we have to take some time, no? 10 annam kada? 10
Sir,
minutes
okay.
break.
Now sir is co-host, sir.
Okay.
Sir, unmute yourself, sir. Nasim, sir. Sir, unmute your video, sir.
Yes, sir. Setting చేసుకుంటానండి.
Okay. Sir, feedback from petition, sir. Day 1 and day 2.
పెట్టేసి. Yeah, welcome, sir.
Yeah, welcome, sir.
Nice to see you.
Thank you, sir. After long time.
Yeah, after long time.
Yes, sir.
How are you?
I'm fine, sir.
Okay.
Now, okay, na, sir, ఇది? Camera?
Yes, sir. Fine, sir.
Is it fine?
Right.
Yeah.
Fine.
Sir, కొద్దిగా వాల్యూమ్ తగ్గించుకోండి, sir. Just
Okay, fine. Is it fine, sir?
Yes.
Yeah.
Fine. ఇది ఓకేనా సార్ ఇప్పుడు?
Fine, sir.
Yes, sir. Thank you. సార్ మాస్క్ పెట్టిండ్రా?
మధ్యలో ఉన్నాం మేము.
సార్
మధ్యలో ఉన్నాం, 4th డే.
ఓకే సార్.
3 days అయిపోయినాయి, ఇంకా 3 days ఉన్నాయి.
సార్
లాంగ్ సెషన్స్. Yeah, good evening to all. Yeah, this is the 3rd session of the day. Actually, this particular topic is concerned to commodity market. You know very well, previous speakers, they covered money market, capital market, forex market, but this market is missed on that day. So because of certain adjustment, now we are into commodity market. So as a student or maybe the investor, they must try to know the different markets which are there in the country or in the world, and what type of transactions which are taking place in each and every market. That you must have an idea about that. And what type of instruments that are traded over those exchanges or the markets. So even a common man also very much required the knowledge about the commodities. Even every day, it may be newspapers or it may be in television channels, they speak about the gold price increased or decreased, or oil price increased or decreased, like. So many types of discussions and analysis which will go on, even agriculture commodities, metals, precious metals, crude oils, like. So this type of information is also very much required. even to a common man. So some of the students which are belongs to commerce and management, they may having certain basic knowledge about the commodity market, but the other students they may not have that much of knowledge about the commodity market. So commodity market also playing an important role even in the Indian market. So that's why we thought of commodity market also. This particular topic also must be there in our workshop. That's why we have included this topic in our 7-day national level online workshop. Now, it is my pleasure to invite and introduce Dr. Narsimulu Siddula. He is an assistant professor at National Institute of Securities Market. He holds MCOM and MBA in the area of finance. He has done PhD in the area of finance and commodity derivatives, effectiveness, price discovery and risk management from Department of Commerce, University, Hyderabad. He is qualified in UGC in management and commerce as well. He is the recipient of Indian Council of Social Science Research, doctoral research fellow from Institute of Public Enterprise, Hyderabad. Before joining NISM, he has worked as an assistant professor in the Department of Finance and Accounting at ICFI Business School, a constant of IFHE, ICFI Foundation for Higher Education, University Hyderabad. He has 15 years of teaching and research experience. He teaches financial reporting and analysis, corporate finance, security analysis, and equity valuation, financial risk management. His research interests are commodity derivatives, capital markets, asset pricing, and risk management. So because of paucity of time, I'm not going to take much of your time. I welcome the today's resource person, Dr. Narsimulu Siddula. So thank you for the opportunity to introduce Narsimulu. Thank you.
Thank you, sir. Thank you very much. I would like to thankful to Department of Commerce and Naresh Reddy sir to give an opportunity to share a session on commodities markets in India. And even being an alumni of Osmania University Department of Commerce, I'm privileged to take the session. Yeah, thank you, sir. Thank you very much.
Yeah, thank you. You have to continue your session.
Yes, sir.
So, to
Sir?
6:40.
Okay. My screen is visible, sir?
No. Yeah, now it is visible.
Visible, sir?
Yes, yes.
Yeah. Yes, sir. Before going to discuss about the commodities market across the world and in India, first, these are the learning outcomes out of the session. First, we'll talk about what do you mean by commodity and what is commodities market and what is commodity price risk and what is its impact and what is the economic importance of commodity derivatives markets and what is commodity market ecosystem and commodity derivative market players and commodity exchanges in India and what actually the advantages value proportion provided by the commodity exchanges across the world or even India and what are the recent developments in Indian commodities markets. These are the learning outcomes of our today's session. Okay, before going to discuss about what is commodity, just which are commodities are in the given various articles are the things which have been presented here. Can you say which are commodities and which are not commodities? Can anybody can respond? Hello?
Sir.
Yeah. Gold. Okay, fine. Next. Which are commodities and which are not commodities? Yes. Okay. Out of the given articles, say if you look at the car is not a commodity, and even diamonds are not commodities, and jewelry part is not a commodity. Only the iron, steel, and copper and gold bars are the commodities. Why? Why? Because the commodity, basically by definition, it is a good which is produced by many producers, or the companies, or the firms, without any qualitative difference, and the producer cannot be identified by examining the product or the goods. Suppose if you look at the car, you can identify who is the producer or the manufacturer. Okay, if you look at jewelry, even you can identify who is the jewelry manufacturer or jewelry maker. Or even diamond, you can say who is the manufacturer of the diamonds. But in case of the steel or copper or gold, you cannot identify this. The gold, if you take 24 carats gold, it is the quality is uniform across the world. And if you are talking about 22 carats gold, across the world, the quality is same. And you cannot identify who is the producer of the gold bar. And even if you take the steel, even the name itself, you can say the Tata Steel or even, but the steel bar, if you take into account, it is a commodity where the across the world, the product, the quality would be same, even the copper. So if you define the commodity, it is a good which is produced by many producers or the companies or the firms without any qualitative difference, and the producer cannot be identified by examining the goods. That's why a ton of steel or the gold, a ton of copper or the rubber produced anywhere in the world, it is a commodity. And even the Forward Contracts Regulation Act 1952 defines goods as every kind of movable property other than actionable claims, money, and securities. So anything which is supplied across the market without any product differentiation, or and for which there exists a demand and its price is determined the function of its market as a whole. So no individual buyer or no individual seller can determine the price. So the market is the price is determined in the market by the collective, the function of the various variables which decide the price. That's why the crude is a commodity and it has one price around the world, and the price is being determined or daily based on a global supply and demand forces. Okay. So with this, you can say what do you mean by commodities, and what if you see across the world, and what is the classification of commodities. This is as per the classification as per the report of expert committee on integration of commodities, spot and derivatives market, Department of Economic Affairs, Ministry of Finance and Government of India. The commodities markets basically classified into agriculture commodities and non-agriculture commodities. Under agriculture, you have unprocessed or raw or farm produce like wheat, soybean, corn, rice, and spices, etc. And you have a processed farm produce like oils, meal products, and sugar, and livestock and forestry, dairy, marine, and plantation, etc. These are agriculture commodities. And non-agriculture, you have a metal complex like precious metals and industrial metals like base metals, and energy complex and others like petroleum products, the crude oil and natural gas. So the commodities can be classified into this agriculture and non-agriculture commodities. Then basically the commodity markets globally and India comprise of two segments. One is the spot market and derivatives market. The spot market is the market where the purchase of commodities or purchase or sale of commodities and settlement takes place simultaneously. And spot markets basically in India especially are very fragmented and geographically dispersed and primarily regulated by the state governments of the India. And whereas a derivatives market where the settlement of trade, either buy and sell, takes place at the future date but with certainty. The commodity derivatives market are well regulated under the statutory regulator. In India, it is regulated by SEBI. So why should we learn about the commodities market? Like being a like postgraduate student or even a common man, why should I learn about commodities market? What is new in this? Basically, if you look at the history of the commodities, it is as old as human civilization. Even before money, the currencies we have, normally the people in the ancient days, they used to exchange the goods or commodities for their to meet their actually needs. So what is new actually? Why should we learn this commodities market now? What is new in the sense, basically the commodity derivative contracts have started getting traded in commodity exchanges. Now, if you see, earlier there was no platform to trade in commodities market. Now the commodities are traded in the exchanges. Second thing is the commodity prices are increasingly becoming volatile. If you see over the past, from the even from 1940s to till 1990, there is, you can see across the world or globally or in India, the commodity prices are like there is no volatility, or there is no more change or in the commodity prices. But after 1991, when economic reforms taken place and globalization and private after integration of Indian markets with the global markets, so the change in the commodity prices are increasing, and that created some unwanted risk in the commodities markets. And the commodities are emerging as a new asset class nowadays. And even if you look at earlier, the traditional investments like only equities and bonds and even financial assets like gold. Now, because of the new emergent new category of asset like alternative investment, AI, alternative investment category, so the commodities comes under alternative investment asset. And even commodities investment also provides an effective edge against inflation. Why? Because if you see across, normally as the inflation increases, the market price of the either security, either equity or debt would come down. If the market interest rates come down, the prices of the equity will increase. But in case of commodities, as the market interest rate increases, the inflation also increases. But these commodities absorb the inflation, and as the inflation increases, the commodity prices also get increases. So it acts as a hedge against inflation, and we will see some of the proofs why it is. So we will see the why to understand what factors contributing the volatility and how the commodity price risk can be mitigated. Here we have seen what is a new thing about learning about the commodities market, why the commodities markets are commodity prices across the world are increasing, are more volatile. We'll see the scenarios now. This is actually the expected this world commodities price data as per the World Economic Outlook, July 2019. World Bank Group published this data. So these are the price indices of energy, metals, and agriculture from 1960 to 2018. This was the last year report. Okay, if you see over the years, the metals, agriculture commodities markets, basic agriculture price indices are very fluctuating. Even you can see more energy. Energy were earlier from 1960, there was and steadily increasing, and in 2019, 92 to 2020, it was little bit slow. But after 2000, in 2009 and 10, there is a high spike. After that came down, then again it is gradually decreasing. And energy consumption, if you look at across the world, crude oil and coal, natural gas, and renewable energies is continuously steadily increasing. The consumption has been increasing. Then aluminum, copper, zinc consumption also is increasing, and lead, nickel, and tin consumption is also increasing. And now we are under the unwanted, unprecedented lockdown during COVID-19 across the world and even India. And even what are the market developments after COVID-19? Here, if you see, these are the latest commodities market outlook to April, published in April 2020 by World Bank Group. So the price indices monthly. Earlier, if you see the price indices of indices across the world, steadily they're little bit fluctuating over 1962, 1990, 2020. But after that, there is a huge jump. Now you see the energy commodities, even the decline in the energy commodity prices. And even we have seen during March, when the lockdown has been announced, the crude oil prices were even came down to around 20, even $30 per barrel. So even commodity price changes since January 20th, 2020. Here, oil, natural gas, rubber, here the prices were highly fluctuating, and oil prices collapsed during the various incidents like during collapse and recovery episodes in from 1985 to 2020. You can see there is a change in the prices in the commodities across the world. And these are the even in the global recession, 2008 global recession, and now compared to 2000 this COVID-19, you can see before oil prices before this recession and during the recession, completely the prices are declining. And even the impact of COVID-19 on commodities market outbreak, if you see, the Brent crude oil prices are continuously declining, even came down to 20 barrel from 70 barrel from January till $20 per barrel. And changes in the transportation demand, and these are the various actually the commodities markets are very volatile due to so many changes, macro and microeconomic at world level and at the national level. And these are the major events, and during the major commodity prices during the major events like this, you can see September 2011 crisis, after that, and COVID-19 crisis, how the prices have been changing. Oil price, copper price, and agriculture price, and even gold price is very steady. Why? That's why you can see why the commodities even act as a safe investment even during unwanted or unprecedented situation like economic recession, financial crisis happened in 2008, and even COVID-19. The gold price have been increased from even it is touched even for 50,000 per 10 grams in India, and even more than 50,000, 52, 53, and now it is little bit it is coming down. So you can see the out of the given product or the commodities, the gold price basically it takes into account, it hedge against an inflation as well as it's a safe investment. And the most of the investors across the world and India, they are trying to invest in the gold prices. That's why the price of gold has been increasing. And even this is latest data from September 3rd. So the price after commodity prices continued their broad-based gains and August in print sheet. This is from World Bank. Even now the prices of the most of the commodities are now recovering. Some energy products have been recovered by 5.29%, and raw materials 3.7%, precious metals 10.3%. So if you by looking at these slides or these sources, you can say the commodities market is very volatile. Okay, and now, and one more thing, the commodities are emerging as a new asset classes. As I said, why we need to learn the commodities market now? Because it is emerging as a new asset class, since commodities exhibit a negative correlation with the most of the asset classes like equity, bond, and real estate. So if the equity market is going down, then commodities market will go up. So let us say, if you want to hedge against your, if you want to make a profit or keep your, if you manage your portfolio, okay, they will shift some of the funds from equity market to or commodities market. That's simply the diversification. So this diversification is the process of reducing the risk. So most of the investors during the recession plays or the bear market situation, they will try to shift from equity market to bond market, because the simple reason is commodities will have a negative correlation with the other asset classes, and investment in commodities are predominantly done through commodity derivatives contracts, that is through exchanges like futures and option market. And one more, the commodities investment is also provided an edge against inflation, as we discussed. So because of these three reasons, one is the markets are very volatile and commodities are emerging as a new asset class, and commodity investment provide an effective edge against inflation. And because of these three, now the commodities markets are growing like anything. And if you see the evidence from the whether the commodities market will have a negative correlation with the equity market, or this is we have done one of the research paper. We have this is from my research paper along with Professor S.V. Satyanan sir and my Dr. Satish Kumar sir. So where we have done how the financialization impacting diversification evidence from Indian equity and commodities market, which was published in 2016, where we have taken this total period of 2005 to 2014, and where we have taken Comodex spot and Comodex futures index, and these are with Nifty index, and we have calculated annualized returns, annualized standard deviation, and Sharpe ratio for the total period of 10 years. And we have classified the total period into three subgroups: pre-recession, the pre-financial crisis 2008, and during the recession 8 to 11, and post-recession 11 to 14 June. So, and overall, if you see the Sharpe ratio indicates overall 10 years period, the Nifty, if you see the Sharpe ratio, the risk adjusted return, overall the Nifty is performed better. But before but pre-recession, the Nifty was performing better, higher than the commodities market, either spot market or futures market. But during the recession, if you see this Nifty performance was almost zero, whereas commodity spot and futures were 0.25 and 0.28. It means during the recession, the commodities markets performed well compared to Nifty. And even after recession, the commodities market went they gave negative risk adjusted returns, whereas the Nifty has given a positive risk adjusted return. There is a reason because of why the commodities markets given a negative risk adjusted return, because of 2013 there was an imposition of commodity transaction tax, and then in 2013 there was a global economic slowdown in the commodities market. From 2013 onwards, the commodity prices were continuously declining till 2016. So these are the reasons. Even then, during the recession, especially when equity markets were performing poor, the commodities market performed well. So this is a reason they have negative correlation with the equity market or even bond market. Then, if you see that why they will have negative correlation, if you look at, we have calculated correlation between commodities market index with Nifty, and if you see the commodities future will, has a negative correlation, and even the correlation is having but low correlation. So that's why if in the diversification, if you studied in your portfolio management, the diversification works when the correlation coefficient between two asset classes moves from -1 to 0, or even +1 to 0. So as the correlation coefficient moves from positive to negative and even 0, you will have a more diversification effect. So this is proved. That's why it is to be treated as an alternative investment asset class. Now we discuss about what do you mean by commodity risk. Normally, if in any asset classes there would be a risk, means expect actual returns over the expected. There is an variability in actual returns over the expected return. But in commodities, in addition to that, there are other reasons which create the risk. Normally, the commodity risk arises out of uncertainties caused by fluctuations not only in the prices but also yields of commodities, especially neither agriculture and non-agriculture. So that's why the commodity risk come from two sources. One is the price risk, that is unwanted price changes in the prices of the commodities. Second is the yield risk, means the variability in actual yield over the expected yield. Are you able to understand? Yes? Are you able to understand?
Yes, sir.
Yeah, if you have any doubts, please let me, you can ask me. Okay, you can ask. If you have any doubts, you can interrupt. Okay. Shall I continue? Yeah.
Yes, sir.
So normally risk actually it is the variability in actual returns over the expected outcome. Okay, but in case of commodities market, in addition to that the price risk, but there would be another risk called yield risk. Suppose if you take the wheat, as a farmer, I may expect this is a quantity to be produced, but actual quantity produced would be different from the expectation because of so many reasons. Either less rainfall or more rainfall, or else the depends upon the pesticide which I used. Okay, or the soil, everything in case of agriculture. But in case of the gold, if you have gold procurement from the gold mines, so that depends upon, even if you take in the crude oil, not only the production of the crude oil but also the OPEC oil and petroleum export countries, they will decide the production, either increase or decrease. So their policies also would impact the yield of the commodity. So that's why there would be two sources of risk from commodities market. Then one is the price risk and second is the yield risk. So what is the impact of this commodity risk? All the producers of commodities, including farmers, plantation companies, and mining companies, they face price risk, that is cost risk, on the prices of their inputs as well as the quantity or yield risk. Okay, so that's why it will impact the farmers and even corporate, the wholesale buyers and retailers, and even exporters face commodity risk, especially when they buy from from the country of the production and export to the country of consumption. Suppose if you are dealing with exporting business, suppose if you are let us importing the goods, importing now in India, normally the government will give some restrictions on exporting of these bad essential goods. Okay, sometimes even if suppose if you are a cotton exporter, you have to procure the cotton and you have to export to the country where the more consumption is there. So in addition to the foreign exchange risk, you also face the commodity price risk. And second, the government. The most important now during the COVID-19 also, the government faced so much, actually the risk on the decline in the revenues, and government faced commodity risk with regard to tax revenues, and particularly where tax rates rises as a commodity price rises. And even if you see, in order to actually eliminate the unwanted participation or the volatility in the commodities market, the government of the SEBI has actually introduced, the government of India imposed the commodity transaction tax in 2013. That imposed actually the more it became as a costly affair for so many participants, and because of that there was decline in the trading in the commodities market. Okay, so then we talk about, so far we discussed about what do you mean by commodity, then commodities market, then we have talked about what is commodity risk, then now we are talking about what are derivatives. I think you must have studied in your post-graduation. So derivatives, basically it is an instrument or it is a financial contract whose value is entirely derived from the value of an underlying asset. So without underlying asset, there is no derivative contract. Simply it is an agreement between two parties to exchange an asset at a predetermined rate after in a future date. Okay, simply the derivatives means it is in a contract between two parties to exchange an asset at a pre-agreed rate in future date. So the underlying asset can be anything. Either it may be a security like equity or debt. It may be a commodity, either physical commodity or financial financial commodity, physical commodity, or even agriculture or non-agriculture. And if it may be a bullion, or it may be a currency, or any other asset. Suppose if it is a farmer, the wheat is a commodity where he may wish to sell is harvest at a future date to eliminate the risk of change in the prices by the due date. Normally in the villages, if you see, most of the farmers, they may actually sell their the cotton produced to the local vendors or the business people. Normally they will have a contract with the buyers of the trading community of the cotton before the harvest of the cotton. Simply they will make, the farmer may make an actually contract with the trader that I am going to sell, this is the quantity of the cotton produced at this price after 3 months. Why? He wants price protection from during the harvest, because during the harvest, because of more production of the cotton, you may expect that the price may fall. So he expect the protection for decrease in price. Okay. At the same time, the trader may have on other side, he may expect that because of the less rainfall, the cotton production yield may be less and the price may go up. So he may come an agreement with the farmer that to buy cotton at a predetermined rate after harvest is completed. So both will come together. Here both parties, the farmer as well as the trader, are exchanging their risks. The farmer is exchanging his risk, that is a decline in the price, whereas the trader is exchanging the risk of increase in price in future. So this is completely what it is a trade-off between the farmer as well as the trader. The same way, simply it is an informal agreement normally in the farmer in the rural community. But if they actually, if it is an exchange, there would be a counterparty, that is exchange. They will take care of the honoring of the execution of the contract. So the price of this derivatives is driven by the spot price of the wheat, which is the underlying area. So what is the actually the value of the contract or the contract price? The price is the what? The wheat price as on the date of the agreement is made or the contract is made. And what is an underlying? The underlying is wheat. So if the underlying is foreign exchange, that is foreign exchange derivatives. Okay, if the underlying is in equity, it is called equity derivatives. If the underlying is an index derivatives. So the derivative simply, it is a financial contract whose value is derived from the value of an underlying asset. And definition of derivatives basically, as per the Indian context, the Securities Contract Regulation Act defines derivatives as a security derived from the debt instrument or the share or loan, whether secured or unsecured, risk instrument or the contract for differences or any other form of security. Okay, a contract which derives its value from the prices or the index of the option or underlying securities. So this is actually the definition of derivatives. Now the types of derivatives, if you see, you have across the world, you will have the 4 types of derivatives, either forward, futures, options, or swap. And based upon the underlying asset, you can classify the derivatives into financial derivatives and commodity derivatives. Now we will talk about only the commodity derivatives perspective. So these are the various types of commodities traded in major commodity exchanges all over the world. Like NMC, we have New York Metal Exchange, okay, London Metal Exchange, and CME Group, and in India especially MCX, NCDEX, ICEX, okay, NSE, even BSE. These are the various commodity exchanges across the world, and these are the commodities which were allowed to trade in the exchanges, in the commodity exchanges in the world. So if you take into account agriculture, the wheat, soya bean, tea, coffee, sugar, this is a list, exhaustive list across the world. Now if you want to see which are commodities are traded in India, are you able to see this?
Yes, sir.
Are you able to see?
Yes, sir.
Okay, now. So normally in India, MCX is the major commodity exchanges, major one of the commodity exchanges, which actually the total trading in India is from the commodity MCX, which actually its total trading value from MCX would be around 85% of the total trading in India in commodities market. So MCX constitute around 84 to 85%, and another exchange is NCDX. It is purely for agriculture commodities, and it the total trading volume in Indian commodities market from NCDX is around 11 to 12%. So if you take into account MCX and NCDX, which they constitute around 98% of the total trading in Indian commodities market, these both exchanges only. Okay, now if you see that which products are allowed to trade in MCX, normally we have 4 commodity, actually the base 4 categories. One is the precious metals, that is bullion. Second is base metals, industrial commodities. Third, energy commodities, and fourth, agriculture commodities. These are the 4 categories of commodities traded in India. In bullion, normally they have gold and silver. These are the actually major commodities comes under bullion market or precious metal market, gold and silver. But you have gold mini, gold gunia and petal, silver mini, silver micro. This is actually the gold contract, standard contracts is trading volume is around 1 kg per contract. 1 kg per contract. The quotation price, normally the price tick for 10 grams gold. Understood? Yes? Able to understand?
Yes, sir.
So normally this actually the gold standard contract, the minimum lot size is 1 kg. Okay, the tick price, the minimum size is what the price denomination is for 10 grams. Whereas a gold mini, the price if you see the price denomination, the contract size would be 1 kg, but price denomination, normally if you see that the specification, the price denomination would be for 8 grams. You can see the product like, sorry, trading unit is 100 grams and price code 10 grams. Here, whereas a gold contract is 1 kg, this is only 100 grams and quotation is for 10 grams. Okay, maximum order size is 10 kg. Then if you see the gold gunya, this is in Telugu we say 1 shower, that is 8 grams. Okay, so basically here the products are basically, normally in bullion we have gold and silver, and based upon the quantity traded, they have classified the sub contracts, gold contracts into sub contracts: gold mini, gold gunya, and gold petal. Okay, like silver and silver mini. Next, in the base metals, you have, that is industrial metals, you have the aluminum, copper, lead, nickel, and zinc. These are the commodities are traded in MCX. Then energies, you have crude oil and natural gas. And agriculture, even actually in the total MCX, total trading from non-agriculture commodities market like bullion, base metals, and energy commodities, which constitutes around 98% of the total trading. Only 2% trading in agriculture commodities in the MCX. Okay, if say total trading turnover is 100 crores, out of which 98 crores would be only from the bullion, the non-agriculture commodities like bullion, base metals, and energy. Whereas agriculture commodities only will find 2% of the trading. So which are commodities are traded in MCX? Black pepper, cardamom, castor seed, cotton, crude palm oil, kapas, mentho oil, narbudi, palm oil. These are the commodities which are allowed to trade in MCX. In addition to that, normally in the commodities, in the derivatives market, you have a futures, options, swaps, and forwards. Normally the standardized forward contracts are future contract. You must be knowing the difference between forward contract and future contract. Forward contracts are basically the bilateral contract, the agreement between the contract between 2%, and there would be a default risk at the time of contract execution, because either of the party may dishonor because of the unexpected changes in the prices. Okay, one price may be favorable to the other party, and another party pay it is not favorable, so he may not execute the contract. That's why the forward contracts are actually popular in the organized sector. So the exchange traded forward contracts are futures contract, where the exchange is taking as a counterparty risk to honor the contract. So it will act as an intermediary. So futures contracts basically which are traded in the exchange, like we have in the derivatives, commodity derivatives market, you have futures and option market. So even option, total products out of the bullion, base metals, and energy and agriculture commodities, only the option trading allowed only in some products like copper, crude oil, gold, silver mini, and gold mini, and zinc. Out of the given list of 18 commodities, only 6 commodities are wherein the options are allowed. Okay, even in the option, only the options on futures contract, not on options on commodities, except gold. The gold pay, now recently they have introduced directly gold option contract. The remaining copper, crude oil, and silver mini, and zinc, where you will have an option contracts of on copper future, silver futures. Okay, this is about the MCX. Now we have NCDX. Basically, NCDX, National Commodity and Derivatives Exchange, it is major exchange for agriculture commodities. Similar to 10 to 12% of the total trading in agriculture commodities. So what are the products are available in agriculture commodities, or which commodities are allowed to trade in NCDX? Like they have even index, like in MCX also, index also recently introduced. Okay, the cereals and pulses, bajra, barley, chana, maize, wheat, moong, paddy, that is basmati, and fibers, kapas, cotton, and guar complex, guar, that is guar seed, and oil seeds, castor oil, cotton seed, soya bean, refined soya bean, mustard seed, crude palm oil, natural white sesame seeds, soft sugar, and spices, pepper, turmeric, jeera, and coriander. So these are the agri commodities are allowed to trade in NCDEX. Okay, are you able to understand? And each product will have its own standardized, the we can say, the specification of the contract. What is the quantity, where is the delivery center, okay, what is the minimum price change, everything would be actually mentioned, and it should be approved by the SEBI before launching the product to trade in commodities market. Okay, are you able to see now? Yes.
Yes, sir.
Now, if you see the structure of commodities markets in India, we have a commodities market, both spot market and derivatives. Normally, this is the spot market or physical market we have, and derivatives market. The spot or physical market, basically here, this is a market where the buying and selling of commodities or trade execution would be done simultaneously. It is for immediate delivery. Okay, the spot market is the market for immediate delivery of the goods or commodities bought or sold, whereas the derivatives market is the market where the trade takes place at a future date, at a pre-agreed rate. Now, in the spot market in India, basically it is a primary, especially for agriculture market, even APMCs, that agriculture market produce committee, agriculture market committees, okay, APMC center at every district level. Okay, you will find an APMC center where agriculture products, okay, or the farmers are allowed to meet the APMC center to sell their agriculture produce. Now, the recent government, central government, actually the announcement during this COVID-19 in the Atma Nirbhar Abhiyan, they even actually let us say they are allowed, even the restrictions were completely eliminated. Even the farmer earlier, the farmer supposed to, if he want to sell his agriculture produce, he is supposed to go to the designated APMC center to sell his agriculture produce, and he cannot sell outside. Why? Because if he wants to sell outside the APMC center, the buyer, the seller, who is actually the trader who is buying, he is supposed to pay the tax, okay, and some fees to the government. So that's why no trader is ready to buy the agriculture produce of the farmers. Now, the central government recently announced and allowed the farmer to sell his agriculture produce anywhere in India. Okay, that is a major reform actually been announced as a part of Atma Nirbhar Abhiyan. So now, actually, this APMC agriculture produce market committees, basically they are actually works under the agriculture committee, sorry, of the government. Okay, where normally it is a nominated board, political the parties may be involved, and the members are the traders who will take the membership. They are only designated parties, and they will procure the products from the farmer. Okay, now secondary sale, there is no secondary sale or absence of regulator platform. So if it is for a spot market, only you have this primary sale, but secondary sales you cannot find the prices. That's why the prices of the commodities market in the spot or physical market, you cannot get the prices. Why? Because they are fragmented and geographically diverse, and you cannot get actually it is most of the prices are only the bilateral prices, okay, forward prices. You cannot get the actual prices. Only you can get if you visit APMC center, you will be getting one model price. Actually, at the end of each day, the APMC center people, they will upload the price of the commodities in the National Agriculture Agri Products portal. Web portal is there, which is run by central government. They will upload the model price. The model price means what? During the day, what is the highest price, what is the lowest price, and average price they will give as a model price, that they will upload in the evening. That is the only price is available for the spot market. But for secondary market, there is no platform, there is no regulatory agencies to take care of the or to trace the prices. Okay, so that's why it is very fragmented market. Now the government of India is focusing on this. The spot market, simply they are bringing the electronic form of exchanges in the form of to trade in commodities spot market. Okay, that is actually one of the agenda the central government of India is taking care of. So where you will expect the national spot exchanges, where the exchange of goods, exchange of agricultural commodities would be taken place. The trade would be executed on the same day for immediate delivery. Okay, the spot exchanges. So that's why they are gradually doing, like you must have seen the ENAM. Now the central government of India or even state government are closely working to convert the APMC centers into ENAM, Electronic National Agriculture Market, where the farmer can see what is the prevailing price in different actually the APMCs across the India, and you can sell the product on the APMC where the price is high. Okay, so that even the local traders, they may quote the price which is prevalent in the national market. That is an ideal scenario. So, but there are so many restrictions, so many hurdles are there still to be reformed. Next, we have a derivatives market. Basically, here the absence of regulator platform for forwards. Why I told you the forward contracts are basically the bilateral the agreements between two parties. Only there is no it is a bilateral contract. And one more thing, there is a high chance of what? Default risk. Either of the party may dishonor the contract on the agreed date because of either, suppose if the farmer, best example, suppose if the farmer agreed to sell his cotton, okay, cotton produce per quintal say 6,000 before harvest, but during the harvest the price has been reduced because of high good rains. The price fall because of high yield in the cotton in the respective state, and the cotton price has been come down to 5,000. Now the trader who agreed to buy may not opt for or honoring the contract. Why? Because he can buy it at 5,000 from the open market. So here, because of there is a default risk at the time of honoring the contract. So in order to eliminate this default risk in the forward contract, now the exchange traded contracts are allowed to trade in commodity exchanges, where the regulator will take care of the execution of the contract. Okay, so where the exchange traded contracts are future contracts and option contracts. Now, what is the difference between commodity spot exchange and commodity futures exchange or derivatives exchange? Basically, the commodity exchange or commodity derivatives exchange are derivative contracts on commodities will be traded such as futures and options like MCX and NCDX, and spot exchanges where the buyers and sellers exchange good for immediate delivery. This is already we discussed, and now even in national commodity spot exchange, we have NCDX. Even recently they opened e-market limited, NCDX e-market limited, and Rashtriya e-market services private limited, so where they are opened the electronic form for spot commodity exchange, where the commodities are exchanged at a immediate delivery. The commodities are traded for immediate delivery. This is a new initiative has been taken place in the NCDX by taking the ENAM, as well as there is a model called Karnataka model. They have taken as the base. Now, these are the list of commodity exchanges in India. National exchanges, we have 5 national exchanges like MCX. I told you it is a one which constitute around 84% of the total, 85 to 85% of the total trading. NCDX is a major commodity exchange for non-agriculture, MCX, whereas NCDX is a major commodity exchange for agriculture commodities. In addition to that, we have ICEX. Earlier, ICEX was separate and NMC was there. Recently, in September 2008, NMC has got merged with the ICEX. Now you have ICEX completely, and BSE and NSE. These are actually equity exchanges. Since the SEBI allowed the BSE and NSE to trade in commodities, so they have provided a new platform, that commodities platform also they have launched. So BSE and NSE they are providing commodity trading. So now we have 5 national exchanges in commodities market. In addition to that, we have regional exchanges like Bikaner Commodity Exchange, Bombay Commodity Exchange, like pepper, like spices and oilseed exchange in Sangli. So these are the specific commodity regional exchanges based upon the regional commodities available. Like we have Kochi with the spices board, like tea spices board is their separate exchange. Okay, these are the list of regional exchanges, and these are the actually benchmark references are in commodity prices across the world. So if you take the crude oil, the traded global benchmark is Brent plus Dubai WTI. The benchmark is only CME, Chicago Mercantile Exchange. They will take this price prevailed in the CME would be the benchmark for the crude oil prices across the world, and that will MCX will take as the benchmark. So natural gas, even the CMI Henry Hub prices as the benchmark, and NMC will take these prices as a benchmark. And copper, LME, aluminum, London Metal Exchange, zinc, LME, lead, LME, and nickel also LME. So these are the traded global benchmarks. So our Indian commodities markets only the price takers, not the price setters. Okay, now they are gradually, even the MCX recently introduced the delivery-based metal exchanges to set the price setters, to become a price setters in the steel market in India, metal commodities in India, since we are the major users of the metals in the world. And crude palm oil, the MCX, and like some of the agriculture commodities, especially the cotton, where MCX the price is the reference price. Okay, and some of the pepper or even chena. Normally our Indian commodities markets are the price setters rather than price takers. So, and this is the commodities market ecosystem. Normally, if you see the commodities market as a whole, you will find normally here the farmer, okay, where you will produce, and there would be a warehouse which provide the warehouse facilities, and the farmer can keep his agriculture produce in the warehouse till the good price is available existed. Then if he wants any finance, he can take the loan from the banker by keeping the warehouse receipts as a base, and and even the quality checking would be there. They will give the quality rating for the produce kept in the warehouses. Okay, then the trader would be there, and this is an exchange, national exchange. Normally that will integrate all the parties who are the stakeholders of the commodities markets, like corporate, farmer cooperative societies, wholesalers, importers, exporters, processors, traders, and even government and cooperative associations. Okay, these are the various stakeholders of the total commodities market. And who are the entities in the commodity derivatives trading? Normally the commodity exchange regulator SEBI from 2015 onwards. Before that, the Forward Market Commission was the regulator of commodities market separately. But in 2015, when FMC was merged into SEBI, now the SEBI is the regulator for both equities market as well as a commodities market. That is capital market as well as a regular market, the commodities market. Then where the commodity exchanges are there, both the national level exchanges and regional level exchanges, and each exchanges will have clearing corporation, that is a clearing house and clearing bank. And normally the buyers are sellers, they will approach the trading members, and the trading members would be the part of the clearing members. Okay, and here the warehouse and the warehousing development regulatory WDRA will provide the warehouses and gives the warehouse receipts authentication, which act as a means of exchange of funds when they need. Then they will be taking care of the clearing house and clearing banks, and the settlement will be taken place. These are the various, actually the entities would be involved in commodities market, and the trading and clearing and settlement and spot exchanges, that clearing and trading, clearing and settlement in the exchanges in the commodities derivatives market as well as the spot market. If it is a commodity seller, either it can be a farmer, but the farmer individually cannot directly enter into the commodities market trading. Okay, because of the actually the even the quantity which he sell would be very less, and he cannot afford the cost. That's why so many limitations are there to and directly participation from the farmer side. But through cooperative societies, they can on behalf of the farmer. The farmers, primary producers and importers, exporters, they will actually they are the commodity sellers, and they will take care of the actually the warehouse receipts. They will keep the actually the produce in the warehouses, and they will get the warehouse receipts, and they will meet the trading and clearing members. As you said, commodity buyers would be there and warehouse receipts. And spot exchanges, there is only clearing member and clearing exchange, but so far in India there is no commodity spot exchange. And who are the traders in the commodities and the futures and options market, especially commodities market? As you know, the hedger, speculator, and arbitrager. Basically, the hedger is the person who wants to minimize his risk. That is, hedge his risk. That is unwanted changes in the prices. He wants to shift. He wants to transfer his risk from unforeseen events. Whereas the speculator, he actually doesn't want to bear any risk. He want to take any risk. So normally they want risk protection against the adverse price movement. So hedging is the main mechanism to reduce the price risk. And moreover, if you see the history of the commodity, actually the derivatives contract, which was introduced in Japan, the first that derivatives are commodities. Normally the derivative product actually introduced in Japan in the agriculture market itself, especially in the farmer. They actually used to protect their price during the harvest. Okay, before and after harvest, the prices would be high compared to during the harvest period. So they want some. Normally, the farmers required by a price protection during the harvest period. So that's why the derivative contract has actually introduced as a risk management tool. That is a hedging tool to minimize the risk. So hedging is the main actually the essence of the derivatives contracts. Okay, second is the speculator. Normally, the hedger is the one party, and you should have a counterparty to assume the risk. Suppose if the farmer wants to minimize his risk, he wants to transfer his risk to other party, transfer his risk, price risk. Somebody should be there to take or assume the risk. So we will be the actually the counterparty. Normally, the speculator. They will try to assume the risk and to make more profit. So simply the speculators are those classes of investors who are willing to take risks to profit from the price changes in the leg. So they will act as a counterparty, and another party would be their arbitrators. Basically, the arbitrators they will be taking the price differentials or imperfections in the markets, either in the equity market or derivatives market, either in the commodity spot market or derivatives market. So what they will do is they will make a riskless profit by entering into two different market at two different prices. So they will enter one market at a one price, and simultaneously they will enter another contract and at another prices. So simply they will make a profit out of the price differentials of the same underlying asset in two different markets. Okay, suppose if you see normally you have a cotton commodities, which are actually the delivery location indoor, and one more is what you will have a cotton. Actually, if it is in the south, you will have in Tamil Nadu another delivery location in indoor. So suppose if it is a cotton is indoor, cotton is traded at 6,000 rupees per quintal in indoor, and in Tamil Nadu, suppose in Tiruchur, if it is 5,000 per quintal, the same quality. So what normally the arbitrator will do is they will buy in Tiruchur at 5,000 and they will sell it at 6,000 in indoor. Simply what they are doing, they are taking the price differentials of the same underlying asset in two different markets. They are making riskless profit. This is called arbitration. But in the long run, actually, since the market is efficient, okay, this price differentials would minimize, and no longer they can make the profit, because if it is one asset, should be traded at same price in two different markets. And commodity derivatives exchanges, what is the value proposition? What are the advantages of having these exchanges? One is they will provide or offer the hedging or price mitigation mechanism. Simply they can enter into the derivatives contract or commodities derivatives contract to minimize the risk. Suppose normally most of the this ITC, the corporate, especially the ITC, normally they have a food processing business. Like they are the major corporate consumers of the agriculture produce, especially wheat. Okay, while manufacturing the biscuits and everything. So what they do is simply, if they feel that the price, because of this COVID-19 or any other thing unforeseen, they are expecting there would be a wheat yield would be declined in the next 1 year. If they are expecting decline in wheat yield in the next year, what they do is they will procure more now itself, or simply they will make an agreement with the farmer now itself, or else simply what they do is they will enter into a derivative contracts like wheat futures contract now itself to minimize the price risk. Okay, derivatives trading helps in price discovery. This is the most important thing. Normally, one of the major advantages of major functions of the derivatives market, whether it is a commodities markets or financial derivatives market, one is the price discovery, second is the risk management. The price discovery means actually it should give a reference price for the future. So the commodity, actually, since the spot market, actually the futures market, it is actually it gives the future expectations of the participant about the changes in the prices. So they will the futures market will give you indicative future price of the underlying commodities. So by observing the prices in the commodity futures market, either options market or futures market, you will get an indication that what could be the changes in the spot prices. So it is simply a price discovery involves the process of determining the price of a commodity through interaction of supply and demand factors and reflects the underlying market condition accurately. So simply the discovered price gives a signal to the commodity producers and consumers. So what is if you want to see the bullion market, recently most of the people they have seen during COVID-19 from the lockdown from March 11th, 2020, the price of the gold has been increased like anything. Till even it was increased from 45,000 to even 52, even 54, 55. So, and even during the lockdown, there was no spot market even. But the future market future market is live. So the trading in commodity, that gold futures contract, option contracts, it gave an indicative price for spot markets in the gold spot market. Okay, and even you have seen during the festival of the marriage season last Shravan Mas, even the price went up to even more than 55,000. So that is only that since the futures market has given the price indication, the reflected price, anticipated changes in the prices, and accordingly the spot market has been reacted and the prices were decided. So the derivative market basically it helps in price discovery. And if you see the Indian commodities market present status from the introduction of the national commodity exchanges in 2004, MCX was started, and trading operations from 2004 onwards. From then till 2019-20, these are the average daily turnovers in the Indian commodities market, which actually it is a source from SEBI and FMC and respective exchanges. And if you see a robust 18% growth in 2018 and 19, I told you before, in 2013 there was an imposition of commodity transaction tax, and when till 2012 and 13, the average daily turnover of Indian commodities market is around 55,891 crores, came down to 32,725 crores because of the imposition of tax. And after that, even the global commodities slowdown are across the world, and the slowdown in China, one of the major commodity trader, actually the consumer in the world, the economic slowdown in the China as well as the other global conditions, economic slowdown across the world, the prices of the commodities were low till 2018. After that, there is a recovery, and even 1920, there is a recovery. Now even the commodities markets are recovering stage. Then commodities wide rates, if you see agri only, you will see less part, but precious metals is around 35 to 40% is from precious metals, and base metals you may have 10 to 15%, energy 20 to 30%. The major trading is from only the precious metals. And what are the recent developments in Indian commodities market? If you see, these are the recent changes from 2017 onwards. One is introduction of new products like SEBI permitted trading in commodity options in 2017 itself. Earlier, till 2017, only commodity futures are allowed to trade in India. Okay, and second is the participation of mutual funds and portfolio management services allowed by SEBI in May 2019, and independent clearing corporation for commodity exchanges like NSDL is there, National Securities Depository Limited, and CDSL is there. They they are the depository limited, and they have clearing corporations like equity exchanges. But the SEBI, the government allowed, you should have, the commodity exchanges should have a separate commodity clearing corporation. That's why each commodity exchange, MCX, they have separate clearing corporation, and NCDX is having separate independent clearing corporation. That is the major development for trading and settlement and execution should be done very smoothly. And after that, integration of commodities and securities derivatives market. Recently in 2017, the government, the SEBI allowed NSE and BSE to give a commodity derivatives trading platform in addition to their equity platform. So now their equity and securities markets and their commodities derivatives market are now integrated. Next, eligible foreign entities are permitted to trade in commodity derivatives, basically in the exchange traded platform, in exchange traded commodities. And even because of once the options are allowed to trade, and there is a growing trend in the option trading, then trade in commodity index based product. Earlier, like in equity market, you have index futures and index options like Nifty futures and Nifty option contract, and contracts are allowed to trade. But in case of commodities, till 2019 there was no index has been allowed to trade. But in 2019, SEBI allowed trading in index based products. Like that's why in MCX there is an bullion index has been introduced and it is traded now. And in NCDX, NKRISHI, one of the index has been allowed to trade. Now you can invest in commodity index in either in MCX or NCDX. And these are the major developments, recent developments which have been taken place in the Indian commodities market. And these are the expected, the developments set to take place. One is the electronic spot exchanges. Now the government of India is keen to allow these electronic spot exchanges, especially in gold. They are trying to start. And after that, so far the banks are not allowed to participate in the agriculture market. There is an argument. There is a school of thought. Some people say that since the banks are they lend most of priority lending basis, they will lend to the farmer. So normally more default from the most of the NPAs are from the farmer community. So since they have an exposure of primary lending, so they are supporting the bank's participation in the commodities market. Okay, to minimize their or to manage their agriculture primary lending portfolios. This is another expected thing, and even this is another the developments the market is expecting, that is participation of pension funds and insurance companies. These are the the expected the road ahead. The developments are expected from the Indian commodities market in India. And thank you. These are the about the commodities market in India. Yes. Any questions? Any questions? Hello? Yes, any questions? Hello?
Hello, sir.
Yeah, please. Yeah, please.
Sir, is there any international commodities? Sir?
International commodities in the sense? Commodity exchanges that you are talking about?
Without boundaries, sir?
No. Are you talking about international commodity exchange or commodity?
Commodity, sir.
International commodity.
Yes, sir.
So these are the list of commodities, na? These are the commodities in. Are you expecting? Let us say, is your question that international commodity traded in India?
No, sir. What is the international commodity, sir?
International commodity. If you see, these are the commodities, na? Types of. Are you able to see my screen?
Yes, sir.
Are you able to see?
Yes, sir.
The PPT.
No, sir. No,
Okay,
there is
fine.
no PPT, sir.
1 minute, 1 minute, 1 minute. I will check.
Okay, sir.
Okay. Sir, start your screen sharing, sir.
Yeah, I'm sharing.
Screen.
Yeah, I'm sharing.
Yeah.
Yes. Now, is it visible?
Yes,
Yes, sir.
So these are the list of commodities allowed to trade in the commodity exchanges all over the world. Out of the given list, in India we have only wheat, soya bean, then sugar, chena, guar, coriander. Coriander is not allowed. Then even rice is allowed, soya bean, cotton, rubber, but butter is not allowed in India. Milk is not allowed to trade. Okay. Then even if you see livestock, normally livestock is not allowed to trade in India, but in CME, Chicago Mercantile Exchange, where livestock also is one of the commodity to trade. Are you able to understand?
Yes, sir.
Like fuels, gasoline, kerosene, crude oil. Here in India, only crude oil and natural gas. The remaining are not allowed. This is a list. There's a global list. These are the commodities are allowed to trade in the world in the major commodity exchanges like CME. We have Chicago Mercantile Exchange, NYMEX, New York Metal Exchange, and LME, London Metal Exchange. And even India, whether commodity derivatives are not allowed to trade. Emissions are not allowed to trade. Electricity, we have electricity spot exchange. In India, actually, electricity spot exchange is there, where you can trade the electricity. You can buy or sell on a T+1 trading cycle. And water is not allowed to trade in India. In commodities
Okay,
market.
sir.
Okay.
Okay,
Yeah.
sir. Thank you, sir.
Yeah. Yes. Any questions? Yeah. What is the difference between commodity and trade? A trade means buy and sell. If there is a buy bid, if trade means what? If the buy bid and sell ask bid, that is sell bid is the same, it is going to be trade, and it could be excluded. Commodity means it is a thing or the substance or a good which is produced without any product, which is produced by many producers or the many firms without any product differentiation or product quality, where its price is determined by the market forces. No individual buyer or no individual seller can determine the price. That is a commodity. Yes. Any questions? Yeah. Yes.
The question in chat box, sir. What is the difference between commodity and trade, sir?
I have told just now.
Okay.
Yeah.
So what is the MCX in the commodity market, sir?
Pardon? MCX, multi-commodity exchange. The name of MCX means multi-commodity exchange. It is a national level commodity exchanges in India for non-agriculture commodities. Basically, the total MCX is the major exchange in the commodities market. Total trading in the commodities market is coming. MCX share is 85%.
Okay, sir.
Yeah.
In case of commodity market, what is the NCDX, sir?
NCDX is the another exchange. It is for agriculture commodities. It is a major commodity exchange for agriculture commodities. MCX is the major commodity exchange for non-agriculture commodities.
Okay, thank you, sir.
Good evening, sir.
Yeah, good evening.
What will likely determine our commodity prices track, sir?
Pardon?
What will likely determine of commodities price tax?
Commodity price tax.
Track, sir.
Can you write in the chat box?
Yes.
Yeah. How can commodities be used in a portfolio and what? And what can they provide, sir? Normally, commodities can be included in the portfolio to minimize the risk.
Okay.
I told you already, if you want to minimize the portfolio risk, you should need to know the covariances between the two assets which are included in the portfolio. The covariance depends upon the correlation coefficient, the interactive risk between the two assets. So if the correlation coefficient is moving from 0 to -1 or +1 to -1, there would be a reduction in the portfolio risk. So as I told you, this already it is proved, not only in my research, so many research have been there where the commodities basically act actually they will have a negative correlation with the other asset classes, especially equity and bond. So even if you see the Nifty and the correlation between Nifty as well as the MCX, Comodex futures or the spot is having negative correlation or low correlation. So when you expect low correlation or negative correlation between the two asset classes, where you can minimize the risk. So normally the commodities would be included as a part of portfolio to minimize the risk. Now if you see now the current scenario, those actually during the lockdown period, especially in the month of March, the prices of the actually equity market has been crashed. Okay, but the commodities market has been gained. So if you have a portfolio of this having some ideal weightage proportion, like good weightage from between the equity and debt, you will be in a better position. Whatever the loss has been incurred in the equity market would be gained from the commodities market. Then at the end of the day, you will be in a better off situation. So normally the commodities would be included as one of the asset in the portfolio, asset class in the portfolio to minimize the risk. Simply, they will work as a better diversification would be done through inclusion of commodities market. That's why now the commodities are treated as an alternative investment asset, other than the traditional investment like equity, bond, or bank deposits. Okay.
Yes, sir. Thank you, sir.
Yeah. Yes. Any questions?
Sir, there is a question in chat box, sir.
Yeah. How can commodities be in a portfolio? What can be the, I told you, sir, just now. I answered that. Still, gold is commodities market. Yes, gold is the commodity. Where if you take in MCX, the total trading gold, if you see that around 30 to 35% is from precious metals itself, the total trading. Yes, sir. Sir, any doubts or any question? Yes, sir. Naresh Reddy, sir. Yes, sir. Done from my end.
Okay, okay. Yeah,
Yes,
any
sir.
more doubts from audience? Any questions are there in chat box?
Whatever the question that I have already answered, sir.
Okay, okay. Okay, sir. Thank you. Thank you for
Thank you.
your acceptance and completing the session. It's a fruitful discussion. Yeah,
Yeah, thank you, sir, for giving an opportunity.
Yeah.
Yes, sir.
I'm very much happy to be
Thank you,
here
sir.
with our program, part of the program.
Thank you, sir.
Yeah, thank you. After a long time,
Yes, sir.
we have a chance to interact.
Yes, sir. Personally.
Yeah. Thank you, sir.
Yeah.
Thank you.
Yeah, thank you very much, sir. Thank you.
Right.
Thank you. Yes.
Yeah, anything you want to interact with me? I'm asking about the participant. You have any queries? Or otherwise, next speaker is ready.
Sir is entered, sir.
Yeah.
Sir is there in session.
Yes. Yeah, good evening, Satish sir.
Good evening, sir.
Yeah, how are you, sir?
Fine, sir.
Yeah, this is the another very interesting session. Even we will face some of the challenges in reading daily business newspapers and understanding the business newspapers. For example, it may be related to stock market, a commodity market, or forex market. So every day results were published in the newspapers. Only some of the important figures were published in the newspapers. Even there are so many columns are there. The columns will appear, or the columns will write a particular article on a particular issue like. So, for example, if you want to know the changes or developments or new regulations, so these are all possible to know through print and electronic media. So, I am very happy for the acceptance, and not only that, introducing Dr. D. Satish. Welcome, sir, for this session. So, how to read business newspapers. Satish, working as professor at IBS Hyderabad, he is heading research, consulting, and corporate training. He published various columns weekly in the Financial Times, OPEC edition during the year 2000 and 2001 and 2002. So, sir sent only a few lines about him, but he is a senior teacher and regular columnist in the newspapers. Not only that, he is working with IBS from so many years. Even we are also having the experience with him in so many programs. He has participated as a resource person in our departmental activities, workshops, seminars like this. Thank you, sir. You are supporting the department from the
Thank you, sir.
last 4-5 years in different activities. So related to student training or teacher training, if a new curriculum may be introduced in the MCOM course or MCOM IS like, and the new courses also we have organized various training programs to the teachers to teach the students in different colleges. In those workshops also, sir helped a lot. He is having a lot of knowledge and experience in the area of finance and accounting. So thank you, sir, for this evening and for your acceptance. And our students are eagerly waiting. So whatever we read or they read, the way they read or the way we read is different. But as a columnist, you know how to read and how to understand the facts and figures which are published in the daily business newspapers, and how to understand a stock market by reading the newspapers like. So what do you mean by crash? What do you mean by a bull run, bear run, right? Every day they publish, and technical persons speak a lot in the even business news channels also. So that type of knowledge is very much required to read the business newspaper. So thank you, sir, for your acceptance. I welcome you for this session. Thank you.
Thank you, Naresh Reddy, sir. A lot of things spoken about me, but I am, I have done my doctorate from Osmania University, and all these sirs are my seniors, and I respect them a lot, and I'm very thankful that they have this confidence in me. Yeah, so let's go ahead with this. The topic given to me is how to read a business newspaper. So I will try to make it more interactive in nature. right? So I want you to participate in this particular program, very aggressively. And I would be asking each of the participants, so please be active. Sir, am I audible? Sir, Naresh Reddy sir, am I audible, sir?
Yes, yeah. Audible.
So how many of you have have read a business newspaper?
Yeah, speak out.
Yes, sir. I'm asking all the participants.
All the participants. That's why I'm telling. Raise your hand.
You can speak. Whoever is raising, because I'm slightly unaware of this Zoom. But anyway, please speak out. Please take an initiative and speak. We have to make it participant centered.
Or whatever you want to speak, you can also speak through chat box. Send message or queries or whatever.
Okay, I'll ask you a few questions. How many of you started reading newspapers, any general newspaper, and what was the age when you actually started reading these newspapers? Yeah, where are all of you?
They are silent.
Yeah, please. I'm sure that you all have read newspapers. Which newspapers did you read? Anything you want to share? Anything you want to share with regard to newspapers? Please let us know.
Yeah, somebody telling that every day from their 19th year of age, like.
Yes, I can read that.
Business newspapers every day. Some are they're sending messages.
Yeah, what are the different newspapers you have read?
Yeah, somebody telling
Times
the
of
Times
India.
of India.
Yeah. Yeah, Times of India is a business newspaper. Okay, so anyone wants to share anything about reading newspapers, and are you having time or are you not having? Are you only watching television? That's also fine with us. Okay, so let's start. I'll break the ice and then I'll ask you questions. So I do hope that you would. So generally, what is a business newspaper, right? So all of us keep reading newspapers a lot, and most of us, started reading newspapers when we are pretty young. For me, when I was small, I used to read, cricket news. So from sports page, we all went ahead and started reading the other political matters and things like that. Then next, my interest was international politics, because when I was small, Russia was being broken up into pieces and a lot of interesting news. So we used to read that a lot. But I never touched the business section of my general newspaper unless, I started, doing my BCom in Nizam College. Now, so what is a business newspaper? Generally, people think that business newspaper is finance, or basically to deal with investments. To an extent, it is right, but it goes beyond, right? It goes, if some of you are chemistry students, if someone is biology student, all of you should be reading business newspapers. And I think you know why. Why do you need to read newspaper even if you're not doing, commerce course or a management course? Would anyone like to share? Why do you think you need to? Let's say that I'm doing, a B pharmacy, and or I'm doing some other course. Why do I need to read a business newspaper? Right? Okay. Please speak out. It's okay rather than sharing. So generally, yes, sir. Yeah, you need to read. So what happens is, all of us started off reading general newspapers, and because I was into commerce, then I thought, okay, I'd make a better sense of my studies if I read a business newspaper, and that is where I started. And almost like daily basis, I have to get the newspaper home, right? Otherwise, what it is general addiction. I see a lot of people reading local news. People like Telangana news or Andhra news. So that all comes in a newspaper, general newspaper. But in business newspaper, something which is very, very generic or which is very specific to news with regard to business only comes. Yeah, anyone want to share anything? Yeah, please speak out. We are quite comfortable with speaking out. So then, we started diversifying ourselves. We started reading newspapers. And what has happened with these things are that, once you start, any particular newspaper sort of becomes addiction. And nowadays, even though, few of them we are getting it to our house, the others, what we do is we read the online version of it, right? So a business newspaper is slightly different from a general newspaper. Now, how is it different? How is it different? Can anyone say? Is there a difference in color? Yeah, is there a difference in color? Yeah, you can speak out. Right? Generally, these newspapers are of different colors, right? You find them in brown or, actually people say that's a pink color. Why do you think it is in pink color? Why are business newspapers in pink? Right? Because, that is where Financial Times, it seems, in 1888, long back wanted to differentiate itself from general newspapers. So it got a different paper in pink form and it started printing. And then that became a norm. So if you are going to any particular shop and you want to pick up a business newspaper, the color is different. But you also know that it is not applicable to all newspapers. For example, your business line comes in normal white newspaper, right? So it is not compulsory that they need to have a different color. But what is very important is initially to make that difference, because for novices, they might have purchased a white looking newspaper and then they said, what is this different news which I'm not able to understand. So in this context, what happens is, they started having a different newspaper, and then later on the entire world caught up with a different color. But apart from the color, you'll also see some of the things which are very different. All what you're going to do in the 6-7 days of this workshop is going to help you to read business newspaper. And I do hope that, you have a better understanding of reading after this end of this course. And you'll also be getting enough motivated to do a lot of these courses, to read a lot of these papers. So can someone name what are the other business newspapers other than Times of India, as someone put? Yeah, you have Business Standard, you have Times of India's Economic Times, right? You have Mint, right? You have business, Hindu Business Line. You have a lot of newspapers. And also very important is you also have the business magazines also. Okay. You have the business magazines like Business World, Business Today, Business India, a lot of others. So, I hope that next time you sit somewhere and you're having some time, please pick up these magazines or newspapers to read. Now, first, what I'll do is I'll just tell you what these things contain. All of us know, but then, and then I'll say, why is it important for all of us to read? And then what I'll do is I'll explain some of the things which are shared in this, and then I'll take up questions. That's the way how I'm going to go. So generally, why do people read, or, what are the things which are there in a business newspaper? Now, all of us understand what is business, right? Business is basically where you're trying to do a certain transaction in the economy. So what does a business newspaper basically talk about? It talks about facts, right? It gives you certain information about business. Now, business means what? Business means commerce, business means economy, business means governance, business means, finance, business means marketing, business means supply chain, business means operations, business means R&D. Some of you people who are only into biochemistry or only into some of these courses, you think, why should I do it? But then if you do not know what is the progress of corona vaccine nowadays, I think you're going to lose out. You're not going to make a good business sense. Because ultimately, at the end of the day, you might be very good at some subject, but what is important is unless you innovate and make it market ready, you are not going to be very successful. And to innovate and to have this business mentality or the mindset is very important nowadays. And all of us have studied right from UGC that research is now oriented towards business or application oriented. So when would you get this application? You'll only get if you know what the other companies are doing, what other fellow researchers like you are doing. So in this sense, what happens is, reading business newspapers is inevitable for all of us. Whether I'm into some odd marine biology, or I'm into, or I'm just doing a small businessman, having a small shop. I need to know what are the regulations. There's this big guy called Reliance who would come besides me. What is it? What is the advantage he's going to have besides me? Should I file for GST? Should I not? So, all these informations are much more better explained in a business newspaper, because business newspaper primarily is to support business or improve the business knowledge of people, right? So I hope that it's very clear that business news is very, very important to all of us. So what does it contain? It contains facts, right? It contains facts like someone is taking 1.2% of Reliance share, right? It contains facts like general facts, what happens in the day-to-day business, right? It has research reports, right? All the business entities, just like how they do political research, they also do business research. So they come up with certain things. They might come out by like the entire SME sector is not doing well. They cannot make a statement just like that. They have to back it up with certain research. Some of them go through this research, work with people, the reporters work with people on the field, and then they come out with this research. They have an analysis, right? So after all these reports are published, you have a great editor who perhaps gives us analysis, or you've got these guest editors who give a lot of analysis on this, right? You also got opinions, right? Opinions are given by anyone. Generally, some of these people are called columnists. So if you are having a contra opinion, right? I remember during those days when I used to write, we used to have a lot of contra people. There used to be, like what Naresh sir has said, there used to be a bull cartel and a bear cartel in the Bombay Stock Exchange. So the bull cartel usually used to think that always get the news into the market that the market is going to go up. And then there used to be a bear cartel. A cartel means a group of people, brokers, who would say, no, we are a bear cartel. The markets are going to crash. You don't listen to them. So what happens is this fight always keeps going, up and down. So what happens is, if you are going to call someone from the bull cartel, definitely he'll give you all the positive things about the economy and country, and you think that the markets are going to go up. If you take an opinion from the bears, the bear will say, no, the markets are going to crash, right today itself. So what happens is you have different types of opinions, but please see the logic. What is the basis on which, and see whether they are opinionated. They should have a balanced opinion at the end of the day. That is very, very important. And the way media is moving nowadays, all of us understand that, it is slightly becoming more opinionated, but then we'll just keep it there. It also gives you historical data, right? If someone wants to see an annual report of the company, someone wants to say, how did Tata Motors start, or what was Jamshedji Tata thinking of when he started an iron ore company in Jamshedpur. So you get all these historical data, which are very important. Tomorrow when you're speaking to your friend, you get these perspectives, which makes you think that, which makes your people to whom you're talking speak, this guy's got good fundamentals, right? It also gives you future data. Some of these people are using a lot of regression, like what you have seen with, one of the sir who was presented before, right? So they use a lot of tools to predict. Today the rupee to a dollar rate is somewhere at 74. Someone comes and says it's going to go to 80, or someone comes and says it's going to go to 60, right? How are they saying it? On what basis? So they will give you all that information. So it is going to give you some information about the future also. Now, future need not be about, someone is interested in research, right? What is the R&D future for a certain industry? It can be a chemical industry, it can be a biochemical industry, it can be anything, right? It can also be general things like, what is going to be the future of transportation, right? Are electric vehicles going to come tomorrow, right? What are the moves? So what happens is all this information is much, much more appropriately given, in a business newspaper. You'll also speak to the people in the industry. So you get a lot of these information there. It also tells you about the interrelationship, right? All of us understand, the interrelationship. Please understand that the companies are not working in isolation, right? A certain, interest rates are going up, or COVID is there, the economy is not doing well, and therefore you have a problem. And the problem is, most of us are losing our jobs, so we cannot pay. So there's something called moratorium. Of course, they're covered in general newspaper, but much, much more general. Then the court comes up and say, what is this moratorium? Then the government has to give an explanation. Then there is a stay till September 28th. Now, no one really knows what's going to happen with, can I extend this moratorium till 2021? Now you've got a lot of these business people giving their views. You might have the politicians also giving their views. I'm not saying that they're completely incorrect or completely correct, but then getting someone who has a knowledge of banking and others, would definitely give a far better, views on that. Then what you also have is you got some trading tips, right? People generally give trading tips: buy this company, or invest in fixed deposits, or invest in EPF. And so what is happening is, again, why do I need to read this? I need to read this because all of us either take loan or we all invest somewhere. So if you take a loan, you want to know where is the cheaper, which bank is giving me cheaper interest rate. Should I keep a gold loan, right? Or should I take a normal loan, right? Should I take a personal loan? So, these things are, a lot of these columns are having wealth management or personal finance planning as one or two sheets in the newspaper. That becomes very important for all of us, because when you're talking in terms of taking a loan, also in terms of investments, right? All of us want to save some money for the future. So should I put in insurance? Should I put in mutual funds? Should I put anywhere else? So you have been going through a lot of these in these 3 days, and you'll also be going through a lot of them in the next 3 to 4 days. But this information is well captured in any business newspaper, right? So it gives you a personal finance planning. How do we start? So a guy at 30 years, where do you think he should invest? So since he thinks he has a long term, people will recommend shares. Put 50% or 70% of the money in shares. Then they'll say, some of these older guys, who are already past 60, they cannot wait for the share price to go up. They'll say it's better put in safer deposit like fixed deposit or some other schemes for senior citizens launched by the government. So you have a lot of these things. And another very important thing, you also have a paper which talks about jobs, right? So there is a job corner also, just like what you have in the other newspapers. So someone of you want to join industry, either as a researcher or as an economist or as in auditing, these jobs are also there, and these jobs are better, there in business newspapers. So so this is an incentive for all of us, that we are not in isolation. We are a part of some business. We are, we have to therefore look at business newspapers seriously. Yeah, please. Is it audible? Someone wants to speak something? Please let me know. Any doubts? Yeah, I'll invite after another 15 minutes. Please participate well. I'm just looking at these things. Till then, you can mute. Okay, I'll call you. When it is in another 15 minutes, we'll have our first discussion, and then we'll keep moving. So as of now, we are speaking in terms of why is it necessary for all of us to read newspapers, business newspapers, and what are those things which are there in this business newspaper. So you also have jobs, you have interviews of people, right, from economists, or it can be CEOs of the company, it can be a research scientist, it can also be an AIMS doctor. So, these things are always there in these business newspapers. And why should I read? Right, so it's very simple that, one is for the personal finance planning. No matter where you are, all of us need money for investment. All of us need money for, for our resources, taking a loan. So business newspaper will give you a better idea of what are the alternatives available. It'll also give you, information from a lot of these wealth planners and others who are there. So you don't have to actually pay money to a wealth management guy, if you really are able to read and interpret business newspaper. So there's a saving for all of us. The other important thing is all of us are in companies. I'm a software guy, or but please understand this, or I'm working in a certain pharma company. What I come to know from these people when we go there for training, and we go there for training on strategy. I was looking at I was training some Canada-based company called Open Text and others. I shouldn't, but when we discuss with their 3-year, 5-year strategic plan, they're not so much on what their the parent company want them to know, because they're so busy with their own programming work or with their own things. They're not looking beyond. And the important thing is, please follow where your company is. I told them that your company is going to go, the future plan is that 60% of your revenues are coming from cloud. They want to make it 70%, and some 30% is coming from database management. They're going to shrink to 20%. Why is it important for you? It is important for you because if I am in database management, I know tomorrow that my company is going to shrink and I might lose my job. Right? So you listen to the CEO's speech, CEO's business plan, So then, should I be there? No, I think I learned cloud computing and I move towards that because that is where my company is going to focus. Or I go and see, where are these database management companies now? Again, in business, which are the leading guys? So you say, okay, I'll prepare myself, I'll do a certain certification and go there. Right? Someone is in generic drugs, someone is into something. So unless you know, and I keep telling this very often for people who are yet to start off, all of us have started off general newspaper with sports magazines and then moved on. Some of you might have started with politics right away, but it's very important that you have a hook. And the first hook is generally, please follow your company. And your company following is much more in business newspaper rather than in a normal newspaper. See where the company is, see what is the CEO trying to say, see what is the CFO trying to say. So, and see what is the earnings guidance. If they are listed, what happens is every quarter, these people meet the business newspapers, analysts. So there's a press report coming. So almost all the newspaper cover these events. And this is important to all of us because tomorrow our job, our employment is at stake. And unless I know where my company is going, and I cannot keep saying, "Arey yaar, we were doing this thing. I don't know why the company closed down." The company will never say you that we are going to close down directly. You are supposed to follow the news. You are supposed to know where the other job openings for you is. Unless you are very good, active, and have a good business sense, it's quite difficult. So what I say, all of you, is first whichever company you are, follow the company news. Then follow, that becomes an addiction. You want to know what is happening in your company. You want to know where is the future direction. Of course, it'll be there in the website, but you've got a CEO who's directly speaking, or interview is there in the business newspaper, so you follow that. Second important thing is, okay, I know about my company, but now I think I need to move on. Then you say, who are the other players in the industry who can take? Again, read business newspaper there. They will tell you who are the other guys, related industries, related companies. You have a comparative companies where they give you, like if you're in Infosys, you have thousands of companies in IT, but is Infosys compared to all? No, they will tell you which are the other ones. Where are the businesses coming from? So there what happens is where your job is going to be. So it's starting off right from knowing your company. That is where you're starting to know the business newspaper. Then you're knowing competitors and industry. Then you think, okay, most of my industry, I'm in the power sector, I'm in ONGC. I think, people are going to move to renewables. And my company is also starting in a small new way. How do I know? Because the CEO has said that, I think the future is in renewables. So let me make 10% of my business revenue is going to come from solar power. Right? So you start to keep moving in that direction. So it's very important that, so I'm just saying how you get hooked. You start out from knowing your company, you start out from knowing the industry, and slowly you will start to know the economy because no one operates in isolation, right? So if someone is saying like yesterday that some 63,000, petrol bunks are going to have electric vehicles charging, right? So you thought, electric vehicles are not going to come to India because there's no charging, there are so many hiccups, and suddenly government makes this announcement. Yes, it has a repercussion for all the, fuel-based vehicles as well as non-fuel-based, because this is going to be a game changer to all of us, right? So don't always see business news as what we talk in terms of finance. It is in terms of business, it is in terms of strategy. I'm a small shopkeeper here, and I'll say, 20 lakhs worth you can avoid GST, and tomorrow the government says 10 lakhs, right? Then you need to be more careful, right? There are some small other things over there, which people have to be bothered. So directly or indirectly, all the people will have a much better business acumen if you read business newspapers. That is what I want to say. And no matter what industry, whether you're from commerce or from MBA or from any other field, tomorrow you're sitting for an interview, and in the initial stage, people will ask you about software coding or something in biochemistry. But you think they're going to ask you the same thing when you're moving up, when you're going to be the process head, when you're going to be the project manager? They're going to ask you the industry contours. And how would you know the industry contours if you don't really understand the business? Right? Because when you're moving up, they see your capability to earn business or get business for the company. Otherwise, you'll be in that sub 1 lakh or sub 50,000 where you're actually only giving the work which is done. So all of us want to grow, and all of us want to know what business is all about. And business newspapers, will make it And I'm also, very happy, that they have organized this so that, all of us, all of you who have not yet started will definitely start, and you feel much more comfortable. I think today is the third day. The fourth day, you start opening the business newspaper, or, you type Economic Times and see, you'll understand a lot more things and you feel a lot more comfortable. So why is it important? I said, what does a business newspaper cover? I said, what are the people, one is, your company, which company you are. That is one of the best way to start off. The second way to start off is invest your money. If someone is having a money, you're always perplexed, where should I invest? Right? Then what happens is someone says invest in shares, someone says invest in mutual funds, someone says invest in fixed deposit. Then you say, okay, I'll read this newspaper, see what are the best mutual funds available for me. I look at, which bank is giving me the highest FD rate, right? So one of the second way, if you want to do is, put your money, then, or you have a choice, right? You want to know which bank is giving the least personal loan. Take a loan, or you invest somewhere. That becomes an incentive for all of you to start reading newspapers, right? So you've got a lot of information over there. Then if you invest directly in shares, that is the thing, unless you watch the business news on a daily basis, it's going to be difficult for you to manage your portfolio, right? So you need to know the company news every time. I think this company is not going to go anymore, so I sell it. Or I think, this company is going to grow, so I invest in it. And I also see 10 comments coming from, 10 different people, editorials and others say, they have this thing called buy, hold, or sell. So they will say sell means, that means the share price has already reached the peak, it is better to sell. Hold means they are not looking at any view, right? You hold, let us see what's going to happen. And buy means that the share price is very, very low. It is time for you to start buying the shares, right? So one of the second reason for you to be there, first is I told you from a company's point of view. Second thing, what I said is, either you invest, right? Or, you take a loan, and if you're investing in share market, definitely you need to look at the newspaper. So generally, when I categorize news items, I look at economy, international economy, right? Because all the world is related. If today the stock market crashes in US, we'll also have a crash here. So it's also to know what is happening outside. If there is a game changer with regard to Oxford, which all of us have thought is going to be the new medicine, and you come to know that one of the person has fallen sick, and they have asked the trials to stop all around, including in India. That is information which you need to know, because there's something which has happened in UK, and we are trying to see what is going to happen to the future. That's a real setback to all of us, right? So you need to know what's happening outside, because we are living in an interconnected world. Whether it is business, whether it is finance, whether it is electric vehicles, or whether it is e-commerce, you need to know what's happening outside, right? That bigger picture is given. Secondly, you also need to know what's happening in India. So how do I categorize it? I'm looking at from top-down approach, international business. Then I'm looking at Indian economy, right? Look at what's happening in the Indian economy. So we are minus 23 down with GDP. What does it show? It might show that a lot of things, right? How do you read? How do you interpret that, our performance has come down? Maybe because all the workers were sent home and there was no one to work, and because we didn't produce anything, and therefore our GDP is low, right? Or you can say that we've been very conservative. People predict that, people are not going to buy, and therefore they have started, producing less, right? So it is all for you to interpret. And the moment you look at these editorials giving different views, you'll know that, there are so many views coming from it, right? So one is the economy. You see where the interest rates are. You see where the inflation is. Of course, you're going to study a lot of these things if you have not studied, right? And then afterwards, what is happening is, just a minute, yeah. And then afterwards, what you see is you come down to industry, right? I'm a banker, or I want to make a future in banking. So you see who are the movers and shakers in banking, right? And who are the top 10 guys? What are the regulations coming in? So then you move towards industry, and then you move towards company. So how you have to look at it is international economy, international business, then Indian business, Indian economy, and then industry, and then company. So most of the newspapers also look at the top of the newspapers, they're categorized in this way. So you have something called international business. You also have economy, you have industry, and you have company. And then they have 2-3 other papers which talks about wealth management, right? Which talks about personal finance planning, which is basically for all of us. And then they have 2 or 3 pages on stock market, where the things have closed and how things are moving. So this is basically how a newspaper is categorized. And if I look at, I've been looking at Economic Times. Generally the first page is the cover page, which captures the major news, but it also has second page in politics. Economic Times and Times of India are there, so definitely it will have a lot of political news which it wants to cross sell. So it'll give you some major political news in page number 2, and then it goes towards companies news, and then it has news on the sectors, and then it has economic news. When I looked at Financial Express, it starts again with the cover page, which talks about both political and major things whichever have happened. Then it starts with economy, what's happening, all the economic news which is coming in. Then company news, it has got editorials. One of the most important thing where you want to grow is always read editorials, right? There are 2 types of editorials. One is where a regular editor gives his views on a certain topic on an everyday. Please understand that it is biased opinion in a sense that he is giving his own views. Second one is they've got invited guests. Invited editors are, industry leaders. Like, someone wants to speak about, the monetary policy, perhaps they would have invited, Rangaraj and other senior people who have. So these are guest people who will give their opinions. Please read those, because what you see is, 70 to 80% of the paper is only facts or information and interviews of CEOs and others. And why is this important? The most important is the middle page of editorials. All of us know right from general newspapers onwards, because it goes beyond, it touches a certain subject, it tells you why what he's saying is why he's saying, and so on and so forth. So please read the editorials in detail if you want to form an opinion, if you want to have a say. Otherwise, what happens if someone asks you a question, how is your industry? And you say, I really don't know. But if you really want to grow, you need to see all these. So please keep a tab on the editorials. Then it has got international business news, then personal finance. Then it has got investors' opinion. It has got some top 10 shares where you can buy, where you can sell, and it has 2 pages on markets. Business Standard, I find it as the most expensive newspaper, but it is worth buying it. It is around 9 or 10 rupees. It has cover page. It has got company news, economic news, editorials, lot of editorials. 2 pages of editorials. This is important, and that is why the cost is more important. And it's got a world news and politic news. If someone asks, why do people read Hindu newspaper? People read because people want to attempt UPSC and other exams. And what do they look at, Hindu newspaper? They look at the editorials because they want to form opinions. And tomorrow someone is asked you. Similarly, even in business news, if you are sitting for any interviews, it is the editorials which actually give you, that forte to give you the confidence in it. For sure, if you're starting off as the first year student, second year, they will ask you only technical questions because they are not asking you to lead businesses or in a small way. But 10 years down the line, right? So what is very important is please, start reading, the newspaper. Also be very careful between articles and advertorials, right? You've got these advertisements which are there, 2 pages of advertisements. Then you've got a lot of other tenders and others, which are basically commercial things. But there are also articles and there are also advertorials. You find that half a page is written very good about a certain institute, but you really don't know why, what is in news. And down you see it is an advertorial. So what happens is it is one way in which, a business model of business newspapers or any newspaper, which gives you an article in the form of editorial. So you actually, it is not a separate box to the left or right side. You actually read it and think you form a very good opinion about that institute or the company. Basically, it is paid, right? So it might not be all true, what you're reading. So please read whether you're reading the advertorial or whether you're reading the newspaper. Right, a lot of things to grab when you're talking about governments. A lot of issues over there. Business, basically, what are the mergers which are taking place? Which company is acquiring whom? Who is coming to India? economy, a lot of the regulator you have seen, SEBI, you've got a lot of regulators, RBI. Listen to a lot of those newspapers, GST. Okay, there's GSTIN, which will release a lot of information. Read a lot on your inflation. You have two types of inflation. Inflation is the price change of the price of commodities moved up or down, right? Read a lot of information on World Bank, IMF, OECD countries, WTO, ASEAN. These are very important things which will tell you what. Also read, you come across these stock exchanges called National Stock Exchange and Bombay Stock Exchange. You'll be coming across all of this, during this 3 or 4, 7 days workshop. You also will have something about NASDAQ, Dow Jones. So these are all some of the indices which are global, right? And you have government policies, you've got budgets, monetary policies. These are something which you need to look at. These are all having an implications for all of us. Then you got the GDP figures, industrial production, right? International news. So please follow all these news, which are very, very important for all of us to read. So I do hope I finished the first part of this, which is generally talking in terms of what is a business newspaper, how does it differ from other newspapers, what does it contain, and the most important thing is, why do I have to read it? Right. Now please don't put in chat. It's okay. I feel comfortable if you ask me. And I'll open it up for discussion for 10-15 minutes before I look at major events, what will be covered, and explain to you some of the terms, though they might have been already explained in your other training sessions. I'm keeping it open. Please speak out. No need of chat. Please speak to me. Have you come across any business news which you have not understood or anything? Yeah, please open up and speak. Yeah, any opinion on and business news or any of these things, please let me know. Please participate.
Please use chat box. Participants.
Yeah, sir, is it audible?
Yes, sir.
Yeah. What has happened is I'm not able to see the chat. I've just shared something. Is my sharing available?
Yes, sir. Yes, sir.
Yeah. So what I'll do is, I'm not able to read the chat box. I'm trying to make it big, but it's okay. Please see. Yeah. Anyone has any questions? Please speak to me, and I'll answer before we move on. Anything? Otherwise, please mute. I'll keep. Because the moment I shared, the screen. Then let me see if it is moving down. It's okay. So let's move ahead. I hope you're seeing what I'm seeing. So some of the things which you need to look at early in the morning in all of us, in all the newspapers, is something like this. You have these things called indices, right? You might have already studied. This will tell you where our stock. So generally an index is a place where what happens is you will have some basic stocks, some top 30 stocks if it is Sensex, and top 50 if it is Nifty. So what they will give you is they'll give you an opinion. You'll be reading all this. Don't worry. You'll be doing a lot of programs that we covered in some of the sessions. So what happens is it'll tell you in a newspaper, definitely in page 1, you'll see the Sensex, up or a green or down red, by 350 points, 200 points. So basically what it covers is how the stock markets have been doing. And if the stock market is showing up, it means that generally, because Sensex, though you talk in terms of 30 companies, they are as good as 80% of the companies. They're so big that if you say if Sensex is moving up, that means that generally the market is moving up. So then you got National Stock Exchange, another very popular one, biggest in India. So there you got Nifty also. So what you see there in paper is Nifty. Nifty is a index of a National Stock Exchange, and Sensex is an index of BSE. So what it means is if things are moving up, it means that generally the markets have done well, or people have bought a lot of shares and therefore the share price has gone up. Now, some of the other things which you would also like to see is they also cover this on the left side. Nikkei is Japanese index, so what has happened in Japan, what has happened in Hong Kong. Dow Jones is one of the important things which you need to see, what has happened in USA. NASDAQ is also in USA, but it has got a lot of technology stocks, right? Like Google and a lot of other companies. So some of those things are not available in Dow Jones. So generally, if you think that these are all market indicators, South Korea's, and you have France, and you've got UK. The 11th one I'll speak to you after some time, but these are generally the markets, how they are doing. And why we need to know this? Why are these people reporting in our business? Because if they are going down majorly, then we also should expect today morning that our NSE and BSE also will go down majorly, because it is a basic business sentiment. Now, another very important thing is what I put here is SGX Nifty. This is actually our own stock exchange, which is traded in Singapore on Singapore Stock Exchange, SGX. This won't be, though it is there in newspapers, this is not of very much importance unless you look at in the website. So you put in Google SGX Nifty early in the morning at 6 o'clock or 7 o'clock or 8 o'clock. It will tell you today when our markets open at 9 o'clock whether the market is going to crash or whether it is going to go up. Because though our markets are trading at 9 o'clock or 9:30, Singapore being Eastern country, our markets are already traded there, which will give you a direction of whether the markets are going to go up or down today. So early in the morning, you see CNBC and others, people will give a trend on the markets very easily by looking at what SGX Nifty is. So if the Nifty is showing upward movement, you think that our markets are going to go up at least initially. So it is more of a lead indicator to tell us where the markets are going. Then of course, you've got sectoral indices also. Some of these are also captured because these are there in business standard I'm giving. So these are something which have like Nifty Bank, they only have bank shares. Now these are general indices. That means they have all companies like Sensex has auto industry, FMCG, banks and others. But some of them only cover this. So what does it mean if our Sensex is going up while our bank Nifty is going down? It means that our banking sector shares are actually coming down, but overall the market is going up, right? So you have Nifty Auto, which only has auto sector stocks, right? So you'll be having the sectoral stocks. So you might have gone through or you'll be going through, but the same information is available on the newspapers also. Now, why is it important for you? It is important because you will know if the market is going up, which sectors are not doing well. Like for example, reality might not be doing well. So these shares are coming down. Public sector units might be doing well. So which is these indicators? You need to look at the first page left side. You'll be getting all these. These will be on top. Generally all newspaper cover Sensex, Nifty, Nikkei, Hong Kong, Hang Seng, and NSE and BSE. They also have these 2 or 3 more important sectoral indices. So I'll tell you. Now there is also another index which is covered by all newspapers nowadays called volatility index. It measures how volatile it is. So all of us might have studied stats. Volatility means, what is the deviation. That means if there is higher volatility, that means the share price or the index is moving up and down more. That means what? It means that there is scope for you to make money. It also means that there is scope for you to lose money, right? So if you look at the volatility index, which is called VX, you look at March, if someone is having internet, or you can have a look in Google, the highest it has touched this year is 84% volatility on March 24th, just few days before or after the lockdown was announced. So higher volatility means you're going in a very dangerous territory. That means the market can move up or down by 84%. So generally, when you talk in terms of COVID, it means 84% downward. What does it indicate? It indicates the general sentiments of the people in the industry, right? Currently, the volatility has reduced from then, and today it is only 21%. That means share price If we are at 35,000 or 40,000 Sensex, it might maximum come down by 30%, means 28,000. It might move up to 52,000. So generally, that is where you need to make an interpretation. Other things which you also follow is you have crude oil prices on a daily basis. And almost people ask me, so you have two crude oil prices given in all newspapers. One is the Brent crude and the other one is WTI. So the Brent crude is actually, given by the OPEC nations like Saudi Arabia and others who generally produce. Now, what is happening is, hello? Yeah. So what generally happens is this, there's a price difference between both of these. So generally in terms of density, you see Brent crude is slightly lighter than your WTI. WTI is actually from the Texas. If you look at US has now become one of the largest producer of petrol or oil. Lucky because of the shale oil and others. So Texas and others are known for their oil. So this price comes from the US market. But generally globally, we look at Brent crude. The US guys look at this. So when you look at whether crude oil prices have come down or gone up, you basically look at Brent crude prices. Okay. So I do hope that you have no confusion now. So this is a market in US, the WTI. Brent crude is followed all across the world. Next, you've got a foreign exchange page, right? Which will tell you what is a rupee to, a dollar rate today. So when you read a newspaper and find rupee to a dollar rate is 73 rupees 60 paisa, and some of you want $1, will you get it at 73 rupees 60 paisa? Yeah, please unmute and speak.
Yes, sir. Thank you so much.
Yeah, please. I think we still have some time. Yes, madam, please answer. Yeah, would you get it at 73 rupees 50 paise? You read it in newspaper and you want to go abroad. So you're saying the dealer is asking, for 80 rupees. So you say, no, I found it in newspaper at 73. Is it good for you? So what would you say? Why is he charging you so much? Would someone like to answer? So what you see in newspaper is not generally what you actually buy, because what you're seeing in newspaper is the rate in the interbank market. So these brokers and others, first they have to buy from the bank, add their commission, and then sell it to you. So if you're looking at newspaper at 73 and you want to buy dollar at 73, don't be shocked if you go to the guy and say, sir, we are, you have to pay me 75 or 76, because it doesn't take into consideration his commission. And first of all, he's also got to buy from the bank and a lot of these. So looking at the newspaper, don't assume that you're going to buy it at the same price. Next comes gold. The first thing what you need to look at is this. You need to look at the gold price in ounces, right? It is somewhere, at 19, around $2,000 is for 1 ounce of gold. So when you look at, people start speculating, sir, we are at 53, we'll go to 60, we'll come back to 48. No. We are dictated more to do with, what is happening in the global markets. And please follow what is happening in global markets. When it says 2,000 per dollar, please understand that, what is very interesting in this is how much is 1 ounce of gold. Most people, please keep this in mind, especially girls who like to invest in gold. These many grams of gold make 1 ounce of gold, 1 ounce. So when you actually convert it, you'll find that the gold is very cheap abroad. And in India, we're paying 53,000 for the gold. The reason is we pay a huge tax. First of all, we have an import duty, right, around 30%. And then we also have 15% of GST or 3% of GST, I think. Yeah. So what happens is it becomes very expensive. So if you want to see when the gold had touched 1900, some 4 or 5 years back, the gold price in India touched 32,000. And now please remember, gold price has come down to 1200 and again went back to 1900, slightly $100 more. But what has happened to gold price? From 32, it has come to 53. Now, what indicates this? This is because of high taxation in India, right? And so please understand that if the tax rate will not change, we would have purchased gold now at 40 or 39,000 itself, right? And that is the reason why you have all these gold scams and a lot of these people being caught at international airports trying to smuggle gold. And you also have an opinion on what has happened in Kerala, right? So this is one clarification on this. Please look out for ounces, and then you can look at what is happening at 53,000. Because what happens is, let's suppose that our government wants to reduce the tax and not add that import duty because they want people to buy gold. It's very, very interesting. When all the currencies in the world are going down, Reserve Bank of India buys gold and keeps as a reserve. But when we want to buy gold, government says, no, India is buying too much gold, and if the gold price goes down, every middle class individual will have a loss. So we do not want them to buy gold, and therefore we are putting this 30% import duty. Is it fair? Right? Central banks are buying, Reserve Bank of India buys gold, but they don't want us to buy. Right? It is for you to speculate on whether it is right or not. Basically, why they're worried is because when we buy, we have to import gold. If we import gold, we need more dollars and the rupee will come down. They're worried about that. Because as it is, we need to buy a lot of petrol. And if you're also buying gold, then our economy will not be stable. That is the reason why they're not encouraging all of us to buy gold, and they're putting the tax on. The other one, what you need to look at is the volume of trade done. So on an average, on every stock exchange, look at this. So many shares are exchanged, so many lakh shares, and so many crores of value of shares is actually exchanged. Right? So there's also a derivative market. I don't want to go into this, being so late in the evening, but you will also have a page on F&O, which is futures and option market. Generally, what it means is that you can buy a share. Today itself, you can go and say someone in the market, I want to buy a share not today, but somewhere in the month of October. How much money should I pay? So I have taken this data from today's stock market. The share price of Reliance is this much. And if you want to buy in October, it is 2181. So this is the one which is there. So what is happening? When will you buy? If you think by October the share price of Reliance is going to go to 3,000, then it makes sense for you to buy now itself. At what price are you getting? 2181 or 2161, right? So you buy it at 2161 and sell it in the market at 3,000. But if you think that the share price will come down, then you will not buy this. So what is very important is you can book these shares early in the morning. You can book it right now in the next 3 months in India. You want to buy a share in September, October, November, today itself you can book it. You'll get your delivery just like your, what you talk in terms of Amazon or Flipkart. You'll get your delivery in November if you book it. You'll get your delivery in October. So these things are also there. So you don't have to buy it now. You can buy it later. Options, I'll tell you, is slightly more complex. I don't want to go as of now. There is also, a guy who looks at charts. If you watch any news or if you watch any newspaper, a lot of charts are there. So charts is nothing but a previous history of the share price, right? And why is it important for me to look at the past share price? Because people who predict share price based on the past believe that share price has memory and it repeats itself regularly. So what is happening is, looking at the past share price, I can easily predict what is going to be the future share. So a lot of these people predict the future price by looking into the past share price movement. Right? You look at any news, any business news, you'll know that a lot of people are looking at, no, there's no speaker who comes without a graph of the share of that particular company. And they'll tell from here it is going to go there, it's going to go down. How are they saying? They're looking at the past history and saying, history of what? Looking at the past history of the share price. Then you have these important data on companies in news. Who are the top gainers? Which share price has increased more today? Top 10 losers. Which share price has come down? Right? And usually every company data you have. What is the share price in morning 9:30? In the entire day, what is the high it has gone? What is the lowest it has touched? And where did it close at 3:30 and 4? And what has been the change compared to yesterday? Has it gone up or come down? And then, what is the percentage change compared to yesterday? 52-week high means in the past 1 year from today, what is the high it has touched and what is the low it has touched. Right? So these things are there in all the newspapers. Now, this is all the data which you come across. Have you come across any data which you want me to explain? I'll open it up for all of you, please. Apart from what we've discussed today. So what you have generally is stock market data. You have data on trade, you have data on gold, you have data on foreign exchange, you have data on crude oil, you've got data on indices. What other data did you see in newspapers at regular intervals of time? Yeah, any specific data you want to share? Or you have read something in newspaper which you're not understanding, please let me know. Okay, now I'm giving you certain important facts. I want you to keep this in mind tomorrow or into the future. This is just, these are there in business standard and therefore I wanted to share it, but some sort of an understanding of what is this. If someone asks you, which is the biggest company in India? At least this you should answer. Yeah, which is the biggest company in India? And on what basis are people saying it is the biggest company? Yeah, no, I'm not able to see the thing. Please unmute and speak. Yeah, which is the biggest company in India? So on what basis do they say that? Means I want to, when will you, on what basis is it said that it is the biggest company? Biggest company in C here, the list is here. If I want to buy Reliance, I need to pay 135 lakh crores. So they say this is the biggest company in India. How do I buy Reliance? I have to buy all the shares. When I buy all the shares of the company, how much do I need to pay? So the biggest company in India is now Reliance. Reliance, of course, has doubled its share price. So when someone would have asked last time, TCS was always the leader. TCS is how many crores? How many lakh crores is it? Right, 8804. This many lakh crores. So which is the biggest company in India? Reliance. Thanks for the last 6 months, the share price has doubled because of its foray into e-commerce and other sectors. Otherwise, TCS was always the largest company in India. The second largest now is TCS. HDFC Bank, third largest. All of us know about Hindustan Unilever, FMCG, fourth largest. Infosys is the fifth largest. HDFC, there's a difference between HDFC Bank, which gives you all sorts of loans, but HDFC gives only housing loan. So HDFC was a parent of HDFC Bank, but see, the child is valued more than the parent. Airtel, all of you think it is written off, but Airtel is there among the biggest companies in India. Then you have Kotak Mahindra, please see, Kotak Mahindra has overtaken ICICI Bank, which has been there for many years, and then ITC. So this is important for all of us that this keeps changing. And based on what do we say, this is the largest company. Based on if I want to buy the company, I need to buy all the shares. If I want to buy all the shares, how much money I want? Look at the amount of money, right? So this is something for you all to see. Other thing which I found is, this. Right? Okay, so what does this mean is that in Nifty, we say Nifty means National Stock Exchange Index, which company is having the highest weight. So generally we think Reliance is having the highest, most richest company, therefore it should have the highest weight, but it is having second highest, 9.5% out of 100. Why is it that HDFC is having 10%? Because when they are taking the weights here, it is based on free float. There is a promoter in Reliance who's holding a lot of shares, and these shares are not available for all of us to buy or sell, and therefore these shares are not counted. So if I remove 40 for 50% of the shares and look at this will fall below HDFC. TCS is also there, but some portion of the shares, 36% is owned by Tata Sons. So those 36% is not counted. So which is the biggest one? And please see, HDFC does not have any promoters, right? And therefore HDFC is having the highest weight. Second comes Reliance. Third comes again HDFC, not the HDFC. The first one is HDFC Bank, so on and so forth. I'll share some more 2-3 important informations before we. Top company according to sales. See, if you go to Forbes magazine gives you top 500, or Fortune magazine gives you top 500. On what basis do they say top? It is not based on the value, it is based on sales. And it's very, very easy that if you look at this Fortune 500 companies, top 100, till recently 70 or 80 were only oil companies. Why only oil companies are having? Because everyone knows that oil is sold. So now, of course, you've got Amazon and all who could beat, ExxonMobil and BP and others. But based on sales, the largest one is again in India, IOC. It is beating Reliance. Also, though Reliance also is in terms of petrol. So look at in terms of sales, all oil companies. So why oil? Because it's very difficult to sell biscuits. It's very difficult to sell chocolates. It's very easy to sell petrol. And therefore, how much you sell, based on the economy, therefore, based on sales, IOC, Reliance, BPCL, HPCL. So these are the largest companies. And SBI, again, bank. So please see, these are all defeating TCS. TCS is earning more in terms of sales than, NTPC or ONGC. NTPC is also largest power. In India, there's power deficiency. Whatever they produce, we will buy. Right? So there is not much of a competition there. So these are in terms of sales. Again, in terms of profit, now I said Reliance is the topmost company. Is it earning maximum profit? No. Who's earning the maximum profit? TCS. TCS is the most profitable Indian company. Then comes Reliance. Then comes HDFC, Infosys, ITC, and HDFC. Right? So these are important. Most profitable company in India, HDFC. Right? Most companies which have sales will always be petrol-based companies all across the world. Yeah? Yeah, please ask me doubt. Yeah, anything? Next. Now, in terms of assets, that means in terms of their value in terms of assets, which is the largest? State Bank of India. Again, all banking sector is the top with regard to the assets. Right? Please see Reliance assets in the non-cash segment. Which company is earning maximum per share? That means, please see here, look at this MRF. MRF is earning for every share it is, that means if I am a shareholder of MRF, for every share it is earning 3,000, this much, value. I hope you can see this. So MRF is giving the greatest return, 3,289. Then you got this Raja Bahadur, it seems, which is giving you, for every share it's earning 1,304. Honeywell. So these are the companies which is earning maximum earning per share. And that is why you all know what is MRF share price. Anyone who knows what is the share price of MRF? Yeah, please share because I'm not able to see. Please speak, unmute and speak. Okay, we'll come to that. Topmost in terms of P means if I'm earning 1 rupee, then how much more is the share price being shown? Look at this, Adani Trains. For earning 1 rupee, the guy is actually paying 3,742. That means it is very, very highly priced. Look at all these shares, very highly priced. This will be understood later on in your life when you really understand finance. But this means that the share price is really overpriced. But why are the people paying so much? 3,742 times the earning is because they think in the near future the earnings will also grow so fast. And that is why this price. So this is what you have with regard to some interesting news which is carried on in most of the newspapers. They also got this data on NAVs. Someone almost all of you might have invested in mutual funds, right? So they don't give you share price. They have something called NAV, which you might have already spoken. So they give you NAV value. That means if a mutual fund has collected 1,000 crores from all of you and it has become 2,000 crores, then the investment value is 2,000. And let's say number of units bought is 10,000. So what you have is you divide that by this. So just like how share prices for companies, for mutual funds, you have NAV or net asset value. Next, you have ETF. exchange traded funds. This data is also available. People talk in terms of investing in paper gold, right? And why is gold not good to be invested? Because you have GST, you have import duty, you have, if you want to buy ornamental gold, you have making charges, and you know that nearly 30% goes in all this. So the government is encouraging all of you to buy paper gold. So this paper gold is nothing but an ETF. So it is directly linked to the price of gold. If price of gold goes from 53 to 60,000, then you're going to get 7,000 profit. But if you are going to buy gold ornaments or 53 rupees worth of gold, 10% making charges, wastage, GST, import duty, export duty, you'll have to pay minimum 75,000. So unless the share price, unless gold price goes above 75,000, you're not going to make profit. So better invest in paper gold, which has nothing of this sort. It is directly linked to the gold price. If it is 53, you can sell it at 50. You also have this real estate investment trusts in India now, like Embassy Office Park. So you want to know that real estate guys are making a lot of money, and you want to actually invest. You think Raheja Mindspace in Hyderabad is earning a lot of money. So what happens is the Raheja group can take money from all of us and put the money in building that Raheja Mindspace. So whatever are the rentals, that particular, if the rentals are more, your profits will be more. So this price of REIT keeps changing based on the rentals. So in India now, you think Bangalore is very good, you can buy Embassy Office Park, which is there in Bangalore. You can become a member of that. So whatever rent they are collecting, if you own 1%, you'll get 1% of that. So all of you know, is it good to buy real estate now? Very, very sad. This share price was around 500 rupees. It came down to 361 because nowadays everyone is working from home, and the office spaces are coming down. So please be very careful when you invest in real estate. This is the last part here. Then I will take in questions. Now I told you MRF is earning so much. How much you think is MRF share price today? Share price of MRF is not 10 rupees or 20 rupees, is 62,896. And just 6 months back, it was at 20,000. 20,000 itself, we thought, 20,000 for one share. It has tripled itself in a matter of no time. This is the most expensive share in India, 62,896 for each share. Honeywell on Automation, 28,000. Page Industries, 20,000. 3M India. Iker Motors, which makes our tractors and all, 19,220. Okay, Sri Cements, 18,373. Nestle India, 14,351. Bosch, 14,000, which makes our ball bearings and others. Bombay Oxygen, Procter & Gamble, which is also a normal FMCG, 11,582. About India, and Tasty Bite, it seems, I think this makes biscuits. Share price is 10,104. So, I hope that, I'll take in questions now. Naresh sir, please, if you can let me know if someone is posting questions, because I'm not able to see the screen, then I'll definitely answer it. I'll take in questions for 10 minutes.
Sir, there is a question in chat box.
Yes, sir.
The MRF rate is based on company share, or it's not fixed, sir?
MRF, sir?
MRF rate is based on company.
Yes, company performance.
Yeah, company share or not fixed, sir?
Yeah, please understand that all the shares prices are not fixed. Every day they keep changing. If MRF profits are going to increase, then the share price will go to 70,000. And if the MRF profits are going to decrease, it might come down to 50,000. All the shares are traded every day in the market from 9:30 to 4 o'clock. So you must be saying, how come MRF is such a small company compared to Reliance? Why is the share price so high? Right? The share price is so high because Reliance is earning 100 or 1,000 times more than MRF. But the number of shareholders of MRF is only 100 or 200 people. Therefore, you get to eat a larger cake. So MRF might be earning 200 rupees and there might be 200 shareholders. So how much will each guy get? 1 rupee. Yep. This, let's suppose Reliance is earning 1,000 rupees, but there are 1 million shareholders. So how much would one get? They will get less than a rupee. That is why the share price. So when you see in terms of companies and share prices, there's no, don't think that MRF is the largest company. It is not even in the top 100. But the number of people who own it are less. Therefore, the share price is more. Okay, that is also reflective here in terms of earning per share, right? When you see each share is earning 3,200, but then its earning is nothing compared to Reliance. But why it is more? It is more because the number of shareholders of MRF, I mean the number of partners, is very less, and that is why the profits have to be divided among less number of people. Whereas if you look at Reliance, very big company, and the share price is only 2,000. That is because the number of people, if they make 1,000, is 1 million, whereas in MRF, if they make 1,000 rupees, there are only 1,000 people to eat. So please understand that share price has got nothing to do with size of the company. Yes, sir. Any other questions, sir?
Sir, over to Naresh, sir.
Yeah, the company share, is there is any expiry for company share price?
Any expansion for company?
Expiry?
No. The company, as all of you understand in commerce, is a going concern. So there is no expiry. So when I keep telling this story, when you read a normal newspaper, the stories come to an end. Today it might be some drugs and tomorrow it might be something. Whereas when you are reading a business newspaper, it can never come to an end so far as you are invested, because as a going concern, we don't expect any of the companies to collapse. So what happens is, it might be Jamshedji Tata who has started it. It will be Ratan Tata. It will be Cyrus. It will be some Sivaram Krishnan, someone. So companies are having infinite life, and someone or the other will. So if I own these shares tomorrow, I will give it to my children, and you will give it to your grandchildren, and so on. So the story never stops. In business news, it would be having different things in normal newspapers, but in business news, it never stops. Unless, of course, companies become bankrupt. Sometimes you see a lot of companies like, Malia's companies. You see, what is happening with Sahara, maybe, so unless they become bankrupt, otherwise, if you're doing business normally, there is no end date. Bankrupt means you have taken money and you are unable to pay. So definitely the banks want money. So they'll ask you to close the company, sell the assets, and they will take their money. And therefore, what is happening is only in that circumstance will you have, will your company come to an end. Otherwise, it never comes to an end. There's no expiry.
Yeah, sir. Recently, Ruchi share price surged like anything. What are the reasons?
Yeah, this is always in news with regard to Ruchi share price. Ruchi soya. So if you look at Ruchi soya, please don't record. In a sense, what is happening is that it is reported that it is into a lot of frauds. Now, when I teach derivatives, right from past 7 or 8 years, I've been telling the number one fraud company is this. Because the point is, it will say, for example, see, when I want to deliver soya beans, I'm supposed to actually, keep soya oil in some of these warehouses and say I'm having this much stock. But there is a claim in newspapers, I'm quoting again, I'm not saying, which says that they give fake warehouse receipt. So I know some warehouse go down who will say this fellow is storing Ruchi soya oil, cooked vegetable oil, which he's having 10,000 tons. Now, based on this warehouse receipt, this guy goes to bank and he raises a loan because he's having asset. But actually, all the barrels are empty. And then having taken a loan, they don't pay back, and therefore it has been pulled down by bankers. And you all know what has happened, that they could not, sustain. So the Ruchi soya has been vanished. And suddenly, what has happened? I don't want to say anything with regard to the political connections and others, but somehow some of the companies escape, bankruptcy because of the political affiliations, or I do not know, courts become very light on that. So what happens is suddenly they found another partner in form of Patanjali. So Patanjali wanted to take over, the Ruchi soya. Now, Patanjali itself, if you see in the last 3-4 years, it has not done well. It itself has a lot of, debt problems and others. But then what is happening is that the number of shareholders what happened is the Patanjali, the owner, is not the guru, but someone else. So he's owning around 90%, it seems. So the remaining shares are only available in the public. So if Patanjali is buying, 90% is held by one promoter, and 10% only is available by these people. So if there's a huge demand for the share. Why is there huge demand? Because people are thinking now Sushi Soya share prices will move up. So what they are going to do is everyone is going to fight for these only 10 shares which are available. Right? Why? Because all the 80 shares are kept with the promoter, 90%. So what is available for him is only 10% for all of us. So when we want to buy that shares, the number of shares available, just like this MRF, is very less. So what is going to happen to that Rusi soya oil? They've changed the name now. So definitely the share price is booming. Share price is booming because they expect that there will be a turnaround with Patanjali taking over, and most importantly, the number of shares available for all of us to buy is less. So there's a huge demand for shares of Ruchi, and there is less supply. So what is happening is the share price will definitely move up. That is what is.
Yeah, another question, sir.
Yes, sir.
Shares also play the vital role of increase and decreasing trends in the BSE.
Share also play a vital role in increase or decrease?
Decreasing trends in the BSE.
Yes, sir. That's all, sir?
This is the question they asked. Pravalika.
Pravalika, shares also shares play a very important role because all these shares are there on the Bombay Stock Exchange and National Stock Exchange. So if the share prices of most of the companies go up, you find all the Sensex and Nifty going up. And if they are not going to do well, then the share price is coming down. Yes, all the shares are listed in those companies, and therefore they play a very important role in moving the share price up, or the Sensex up and the Sensex down. I didn't get the question properly, but I hope that is what.
The question is very simple, sir.
Yes, sir.
Now in BSE, the share prices, the trends means indexes are increasing or decreasing. Is it because of share prices or not? That they are asking.
Oh, why is BSE different from NSE?
Yeah.
Yeah. So what is happening is when we construct an index, the oldest index when we started was BSE. National Stock Exchange came very late and after liberalization. We had a Bombay Stock Exchange for more than 100 years. It's one of the oldest stock exchanges. Then when they started making these things in 1980, what they did is they started off, how index is constructed. It's more to do with quants. So what they did is they took those 20, 30 companies at that time, when 1980, and they added the share price of all these companies into number of shares. And let's say that it has come down to some 5,000 crores. That 5,000 crores they put in the index as 100. So BSE started off at 100 and now it is at 39,000. So what they are saying is then slowly, as the share prices increase, what happens is the index also starts moving up. So it is an index. Now, what has happened to NSE? NSE has not 30, but it has got 50 stocks. And after liberalization, when the government started, promoting NSE, they started taking 50 stocks, and they started also at 100. Now, what is very, very important is, yes, there will be always, please understand that BSE is 4 times, generally that is the logic in the industry, 4 times more than the NSE. That has nothing to do with companies or shares. That only has to do with the index construction. And you will study the index construction in any course in quants, right? So you have a base when you start. I could have started at 10,000 also, or I could have started at 1. So in 1980, had you bought those Sensex at 100 rupees, today you would have got 40,000 rupees for that. So it is a different construction. There is no relation. But generally, when NSE goes up, BSE also goes up because most of the shares in the Nifty 50 are already there in the BSE index. So out of those 30 stakes, if 20 shares are there, at least 20 shares are there in NSE. So both of these will give you the direction similar, but both the values are different. One is at 11,000, other one is 39,000. That is basically because of pure mathematics. It's basically because the index construction, when they started at that point of time, was this.
Sir, another question from Mayank Jain.
Yes, sir.
What do you say about LIC listing?
What do you say about NSE listing?
No, LIC, Life Insurance Corporation of India listing.
Yeah, so all of us, have, LIC is, very large, very large company. And you imagine, what will be the value of the company if it is listed, right? So see, basically government needs money. And one of the ways in which it earns money is through disinvestments. And, why not, LIC, which is a government owned company and government wants some, and let's say LIC value is more than Reliance, why not? I'm sure, the value of that company will be more than Reliance. Companies, if the government is keeping still 90% and selling 10% to all of us, and we are buying shares, government might be getting some, 3, 4, 5 lakh crores. And this 5 lakh crores is going to take care of its, military requirement or whatever it is. So it is good. But please understand that before making, if you're being from government run to this, a lot of due diligence, a lot of things have to come in control. But LIC will be now open for scrutiny for all of us, right? And therefore, it will be a challenge. But one important thing is, now it is a great opportunity for us. But, I can only say that it will be one of the largest company in India. It might be a good company for someone to buy initially, but then it all depends on, I'm sure government will own 90%. Till it owns 51%, it will only nominate all the board members. And if anything happens to LIC in the middle, government only will take care so far as it is 51% owned, which is public sector. But if it gets down to less than 51%, then becomes a problem. If it sells to someone like Reliance and others, I have no comments. But I'm sure government is only planning to sell not more than 20-25%, which is mandatory for listing. So any company which is listing, 25% has to be sold. So 75% the government will keep. Sorry, in case of PSUs, they can sell only 10% also. So the government can keep 90%. So that is not a problem with it. And I'm sure government will be the majority shareholder. Otherwise, the public outrage will overweigh its requirement for money. Yes, sir.
Yeah, mid-cap.
Sir?
Market capitalization of LIC.
Oh, I told you that, here you have seen, already Reliance. I'm sure it should beat Reliance also. But only thing is Reliance is overvalued a lot in terms of, it is promised a lot of things. It will enter into a lot of fields, and therefore there's a high price which is there. Whereas in LIC, there might not be that price because it is basically into insurance, and insurance is not very, very, the scope is there. We say only 4% or 0.4 insured, but we have to bear the risk. If it is like COVID and other situations, the valuations will be less because claims might be slightly more. I'm talking in terms of life insurance also. If you expect more people to, do this. Why not talk in terms of Indian Railways? If Indian Railways is going to be listed, it will be one of the topmost company, top 10 in the world, it seems, top 5. So, but then, that will also, slowly they have started privatization of some routes and others. They also got these IVRCL, Concorde, they're all railway subsidiaries, and they've been sold now. So slowly they will be sold. Yes, sir.
Yeah, that's it, sir.
Yeah, thank you. Yes, sir. Thank you very much for giving me opportunity, sir. And I do hope that all of you, at least little bit, have got some information on the importance of reading business newspapers and how to interpret some of these things which keep repeating in the first page and in the last page. And please keep reading. It will be definitely profitable to all of us. Thank you. Thank you, sir.
Yeah, thank you, sir, for your lecture, and you have sensitized the certain terms, terminology, you have sensitized and explained. But what is required to a common newspaper reader other than commerce and management? So they know the terms, but they don't know the real meaning of it.
Yes, sir.
Yeah, that real meaning now they are in a position to know now. Now, not only that, they must go on reading, and they will get the more amount of knowledge. Now, not only in the stock market, if you observe, but whoever investing, they are not all commerce graduates or postgraduates.
Yes, yes.
They are engineers.
Yes.
They are law graduates, like. But interest is important.
Yes.
if they have the interest in the capital market or money market, whatever the market, but they must try to read first.
Yes, sir.
So what is required? They must concentrate on Saraswati, not on Lakshmi in initial days. If
Yes,
they
sir.
concentrate on Saraswati, it is well and good.
Yes.
Straight away, if they dump the money in the market, so Lakshmi will go out.
Yes.
But anyhow, they will come with Saraswati after losing money.
Yes, sir. So
yeah, they must play the game by taking Lakshmi and Saraswati into account. So
yes, sir.
which one they want? According to that, they must go into the market. So in initial days, my sincere advice is to go with small amount of money that they try to invest, and later on they must try to know the things by learning, listening, or discussing. Like if they do like this, out of their interest, forget about your degree. You may be MA, you may be MCom, MSc, whatever it is. But try to know the things. For example, index. SAR is already shared. What is BSC, Sensex, NFT like. So try to know what type of things that are involved or which company is involved in Sensex or Nifty like. If you read, you will get the answer. What do you mean by category A companies, B category, C category like? So there are so many terms which are there. So capital market is a big subject. It is very difficult to go with only 1 day or 2 days like. It is a continuous reading. That's why newspapers covers various information. It may be capital market, money market, forex market, commodity market like. It is not that much easy to read the paper. Each and every page it is not possible to understand. So try to read and try to slowly reading various columns with facts and figures. Now you will get the knowledge and you may be exposed to the different terms. Now not only newspapers, you can also go through the business news channels. Lot of inputs you will get out of the discussions and debates. Every day they call from the industry people. Now they can also go by the discussions and debates. So that will helpful to you. So thank you, sir, for your presentation and the knowledge which you shared with our students. I am very much grateful to you, sir, for accepting our invitation and speaking on how to read the business newspaper. Thank you, sir. Thank you.
Thank you very much, sir, for giving me this opportunity. Thank you, sir.
Thank you, sir. Sir, please stop your screen sharing, sir.
Yes, sir. I'm unable to do. I just try to log out. Let me see. You know, when,
Okay, sir.
Yeah, close this. Yeah, I got it.
Yes, sir.
Yeah, I think I'm now out of it. Yeah, thank you very much. So can I leave now?
Yes, sir.
Yeah, thank you, sir. Thank you very much.
Thank you.
Thank you, sir. Dear participants, feedback form is.
So please fill the feedback form. So thank you for your patient listening from the 2 o'clock to 8:10. So because of your support only, here we are conducting continuously. Thank you for your presence here.
Shall we close, sir?
Hello.
Sir, shall we close, sir? After 2 minutes.
Yeah. After 2 minutes. You have to wait. Venkat.
Sir.
Now, Bhattu want to speak with you.
Okay, sir.
You want to ask some doubts.
Sir. అన్న చెప్పండి అన్న. మీ సిస్టమ్ దగ్గరకు వస్తాడా సార్?
ఇక్కడ నాయన కింద ఉన్నాడు.
అంటే మనం యూట్యూబ్ క్లోజ్ చేద్దాం సార్. యూట్యూబ్ లైవ్ ఉంది కదా, లైవ్ క్లోజ్ చేద్దాం.
ఓకే.